Apologies, Madam Chair. I'm not getting any audio. I don't know if you're muted there in the conference room.
Asset are those people that walk in and out of doors every day, and we're slowly building our staff to full capacity here. It's just so pleasing to see that. On the macro side, we're 2 months into a presidential election year, and we've got an incumbent running for re-election. That always means similar things for the economy and financial markets every time we get into a condition like that, at least over the last 60 or more years. So the economy tends to be okay to good in that fourth year of a presidential election year, particularly when an incumbent is running. Stock returns tend to be okay to good. Employment tends to be strong. Energy, specifically gasoline prices, tend to fall in price. And the Fed is usually quiet. I look back, and the fewest rate cuts or increases in any year is always that fourth year of a presidential cycle, and particularly when an incumbent is running. The Fed just wants to be quiet, does not want to be seen as politically helping one side or another in the election. So the Fed's already pre-announced 3 cuts for this year, and I bet they stick to it. Every one of these years are a little bit different, but there are a few things that are playing out. First, government spending has been huge in the last couple of quarters. Normally, the government is 16 to 17% of GDP. They were almost 30% of GDP. It looks like we're still looking at the numbers, but they were almost a double in the last couple of quarters in terms of their contribution to GDP. Government hiring has been very strong in the last couple of quarters. Energy prices fell 25% in the fourth quarter last year. They've recovered a little bit so far this year, but I think that has more to do with geopolitical events than anything else. And then, like I said, the Fed's announced three rate cuts this year. That's their expectation, and I would bet they stick pretty close to that. They like their independence, and we like their independence. There are a couple flies on the pie. Stock market valuations, we talked a little bit about that last month. Stock prices are so high right now, but even accounting for interest rates and inflation, look back in history, and whether you use the history of sort of the peak of the market in 2000, or you go back a little further to the bottom of the market in 1982, which began this big cycle we've been in, or you go back to post World War II, or you go back to the Great Depression. No matter really what time frame you use when you look back, when stock prices get this high, and accounting for interest rates and inflation, our bond portfolio over the next 10 years almost always beats stocks. There's a little bit, or a few times when stocks beat bonds over the ensuing 10-year period, but when prices are this high, bonds beat stocks. Most cases. We're going to go through that in more detail with the investment committee next month, and kind of depending on their reaction, we'll bring it here and show you that data. But it's amazing how high priced we've gotten the stock market these days. There's, as we all know, there's political division that's causing some angst, and that can be seen in the consumer confidence numbers. So that's another sort of fly on the pie. And last, potential inflation. So we've got a really good study. It was done by an economist at Strategic, one of the services that we use. They looked over several different countries. I think it was 30-some countries over 60 or so years at inflationary periods in those countries. And almost always there's a double inflation. So you get the first big run up, central banks respond, down comes inflation, but you get a second wave. And last month we had a surprise to the upside on inflation. It was a couple of tenths stronger than what economists were expecting. So potentially that's the start of a second wave, which would not be unusual relative to history over lots of decades. So that's kind of the risks it seems like right now for us. What's it mean for the portfolio? Well, as you know, and as John mentioned, we've got plenty of cash and lots of bonds, and that's due to the big inflows that we've had. So we're on interim allocation targets, which are much higher to bonds than we normally would be, much higher to cash than we normally would be. So I think we're still, sitting pretty well for what's coming. Nobody knows what the stock market will do over 1 year or 2 years, or what the bond market will do over 1 year or 2 years. But we do know in the long run, we're in a pretty good position relative to our normal allocations, or our stock allocation. So that's what I have for you. Answer any questions or talk about anything you want.
Yeah. I have one question. I think that Jimmy Carter would take exception to your analysis.
Yeah, I bet he would.
On to our Thank you. It's nice to see the table full. I'm Marcia Beard with RVK. My co-lead, Matthias, is out ill today, and John Bacon today, so I'm going to go through this report. Last time we met, we did go over the December flash. This is the full executive summary, so there's a little more detail here. I know you have a very large agenda. I'm not going to spend much time on market environments because we've gone through it, but only to remind you where we were at the end of the year, just to set the stage for what we're going to look at. At the end of 2023, I know that the fourth quarter was much better for markets than any of us thought, both equities and fixed income. In fact, if you look on page 19 of your diligence, I'm going to start with fixed income, go down to Bloomberg Ag, the benchmark for fixed income, just for the quarter. The fourth quarter of 2023 was up 6.82. So a strong performance from fixed income markets. Economic data was moderating, inflation was cooling, Fed was saying they were going to be it looked like they were going to be more accommodative, so a lot came together to provide a good, strong return for the fixed income markets for the quarter. Interesting enough, for the year, and in fact, for the calendar year, up 5.53. So there was a lot of volatility in the markets. I know Matthias showed you the yield curve. Actually, and that's on the right-hand side of this page. The yellow is at the end of 2022. The green is as of the end of 2023. You see that the line is short-term higher for the end of 2023. Again, that's what the Fed controls the short end. But if you look towards the long end, it really was on top of each other from year to year. But within that year, there was a lot of volatility. I think we also reviewed the 10-year Treasury, which started the year with at 3.75, had a lot of volatility down to around 3.3 up to almost 5, and then ended the year at 3.9, which is close to where it started. So a lot of volatility in the Treasury yield curve as well. For the equity markets, strong equity returns. The S&P was up over 26% for the year. 11.7 of that came in the fourth quarter. Heard a lot about it. We've talked about it. It was really driven by 7 stocks. I think we know all. I didn't go through them, but if you look at the S&P 500, which I said returned over 26%, those 7 stocks returned 85%. And the other remaining stocks returned 10.9, so still a strong return, but the market was very narrow, driven by these very strong performing stocks. So the market appeared to be stronger. It wasn't as deep in the strength, but still positive returns, better than expected. So setting that stage, let's go in and look at your portfolio at the end of December. I'm going to start with asset allocation on diligent 23. And we'll go through, I just wanted to point out to the council members that we made a change to this report, and I'll show you on land grant, where we're looking at the asset allocation. We show you the minimums, the maximums, the current, how it's allocated currently, and then the interim target, because we talked about how you can't get to the long-term target immediately. It takes a while to get there. But we're also showing you what that long-term target is, to keep the eye on the ball, to know what the council has chosen to be that long-term target, and that, to keep an eye on making your way to get there. So wherever there's an interim target, we're showing both the interim target and the long-term target. And we're happy to revise this report in any other way you'd like. It's your report. So for land grant, you can see close to their interim target, very close to the interim target ranges under in private market, private fixed income markets. Again, it takes a while to get there. Tom and Nikita are working to get those assets deployed. Again, you don't want to do it all in one fell swoop. So again, the interim target is there to kind of move to that target allocation over time. Page 23 also shows the severance tax, and you can see again that it's both the interim and the long term, but you've been on your interim target. In each of these, you'll see cash, and this has discussed that over multiple meetings of the cash. It hasn't been a headwind as it would have been as much when cash wasn't paying any money, but you are receiving a lot of cash flow in. The following page, which is page 24 and 25, show also the other funds and their allocations. Again, if there is an interim in place, we're showing both the interim and the long-term targets. Going to page 27 and beginning the discussion of performance, we got a peek of this last meeting, and again, diligence 27 and our report is 10. And stop me if you have any questions.
Marcia, thank you for the new graph on page 23. If we can have the same equivalent on the 10% versus 22%, since they're both under 10%, on both graphs, just so it's easier to look at them based off of like.
Oh, the same, yeah, that drives me nuts too. So,
thank you.
We will make sure to do that.
I kept looking at both figures.
Yeah, I know.
Why is the 6.91 and 6.98 so different?
Thank you. I'm sure we'll make sure that we align that. I'll write a note. Okay, to page 27, 10 of our book. Again, this executive summary is the board's report. It was designed to allow a quicker look to see if you're meeting your policy expectations. Again, we can change it however you'd like, but this on page 27, we're looking first at performance for land grants, and the expectation is to outperform the interim policy index over a 5-year period, and you can see land grant for the 5-year period did not. It trailed by 5 basis points, so therefore the no. If you look at the other time periods below the 1, and you outperform by 50 basis points, the 3, 30 basis points. So the 5-year period you underperformed, but the 1, 3, and 7 you outperformed that benchmark. But for the 5-year, which is set in policy, you did not. Severance tax is shown below. Again, a similar story of when you've outperformed and when you've underperformed against that policy benchmark. So for this policy states 5 years, again, it's a no for severance tax. I'm going to now move you to page 29, which just looks at the 1 year for land grant and discussion of attribution. For the 1 year, you did outperform. So for the calendar year 2023, you did outperform. This is a attribution, again, the green line up above is your return. You returned 10.27. You outperformed your policy benchmark. And where did that outperformance come from? Well, looking at this chart and the tables down below, you can see the yellow, it says taxable asset allocation. That simply means were you at your target allocation at all times, and you weren't. Remember, you had cash, and so that cash in a rising equity market and fixed income market, that was a headwind to you because you had cash and didn't enjoy the strong performance in the equity market. So that for the year was a negative. Style selection means simply did your asset classes perform in line similar to the benchmarks, and that was pretty flat, 5 basis points to the negative. But where your outperformance did come is the purple line and the purple graph on the right-hand side, where manager value add came in to play for the year, and your managers added value to the portfolio and contributed to the outperformance against that benchmark. We have the same information for severance tax. I was going to then take you to page 32. If you're interested in looking, we talk about percentages, we talk about returns, but this is the schedule that the former council asked to see, they wanted to see in terms of dollars. So on my page 15, if you look at the top, that is the total fund, which includes all the underlying funds, including the external clients, beginning at $38.3 billion, ending the year at over $49 billion. That's for the total fund, and then it breaks it down by the individual fund. So in case you're looking at your you want to see in dollars instead of in percentages, those two pages are important for you to take a look at. Not an objective, I'm going to take you to page 36 now, not an objective, but it's something we always talk about. It's not an objective to outperform your peers, but it is informative to know how you've done against your peers. This on page 36, we always say it's a complicated chart, but you can see at the top, this is for land grant. You have your land grant total fund and your land grant interim policy index, and then the grouping below it, all public plans greater than $1 billion. This is the benchmark or the universe that's most commonly used by many of your peers. It's a broader universe, and there's more participants in it. There's at the quarter end, the population was 97. So how did you do against your peers? For the short term, for the quarter, because you have a lower allocation to public equities, you ranked below median. For the short term, if you look, and that's the highlighted blue line, if you go out to the 3 year through the 10-year, you can see that you had above median performance. In some cases, definitely top third with the exception of the 5-year, which again is 45, which is above median. Now, interesting on the 1 year, remember the 1 year you outperformed your benchmark, but you rank below median for peers, so that tells you it's about asset allocation, right? So not having as much public equity in your portfolio during that time helped you in other periods, but for this period, you've ranked shorter term period, you rank below median, even though you beat the benchmark you set out for yourself. Then we show you against other universes as well, but I can tell you that I'm working with other clients that the most commonly used is that greater than $1 billion. Going to the next page, which is page 37, this is looking at your rolling ranks against that peer universe, going through history back to 2000. This is looking at a 5-year period and then looking backwards for that 5-year and what was your rank. Towards the right-hand side of the chart, you're more above that median line, the 50 line, saying that in the most time periods, actually, in 35 of those 41 time periods since beginning 2014, you've been above median instead of having the pattern that you had before, which was either at the top or at the bottom, the top, the bottom. So being consistently above median 85% of the time above median and has served you well. That translates into the next page, looking at your Sharpe ratio, which is your return per unit of risk and where you've ranked in the top quartile for that same time period on the right-hand side of the chart, so more recent time period, which is a great place to be. So risk-adjusted return per unit of risk, you've done very well. Page 40 of the report shows your allocation compared to these universes. The only point here I would make is the number in the brackets. If you look at the land line, it says land grant, and it says U.S. equity 17.55. The number in the bracket is where you rank against your peers in the allocation. So what this tells me is your allocation to U.S. equity is below median, so you have less in U.S. equity. You're close to median on your non-U.S. High into fixed income, but that includes your private fixed income, so that's not all just core fixed income there. So this compares you to how your peers have invested. So a little more conservative, which is also reflected on the next page where we look at the risk-return chart. The top left-hand side is looking for the 5 years. The land grant is the green diamond that you can barely see under the yellow, which is the policy index. So what this shows is you have below, for the 5-year period, you've had below median compared to your peers, volatility, but you've had above median return or at median return. And the same information is shown for the 10 years on the left-hand side of the chart. Quickly going to asset class performance, I'm going to take you to page 46 and go to the public asset classes, and we have reports from your specialty consultants today, so I won't go into that. But this is looking at what your policy expectation is for U.S. equity. Your policy expectation for U.S. equity is to outperform the Russell 3000 over the 5-year period. There is a note here, because remember you've done transitioning in your public equity. Look at shorter time periods, so for the 3, you've outperformed. You reposition this portfolio, you have a new asset class director. The shorter time periods, you've shown nice outperformance against that benchmark, but longer term, there was some struggling to outperform that. In a market environment where active management for the piece that you have active advantage of, you weren't alone. Complete indexing in the U.S. equity markets for that period of time was the place to be. That's not always the case. Down below that, we show the large cap composite and the small cap composite if you're interested. Again, large cap has outperformed in this market environment with the exception of the quarter and the fiscal year-to-date period. Large cap has been the place to be. And you can see that composite performance. Thought you'd like to also just see on a risk-return basis on the following page that both your composite falls in that northwest quadrant where you've had below median volatility or above median return for the 5-year period, similar to the Russell 3000 index if we're looking at U.S. equity segment for peer funds. And how your portfolio is positioned briefly on page 48. So here you can see how the portfolio is transitioned to take less, be more like the market, and that's reflected in the cap weighting and in the sector weighting. Non-U.S. equity on page 50. Non-U.S. equity long-term has beaten your policy expectation. Shorter term is where it has struggled a little bit. But long-term, you've met your policy expectation, outperforming your benchmark for the 5-year period by 54 basis points. And how you're positioned on page 52 compared to the international markets, being very close as well on market cap, and then on regional weighting. Lastly, for me, on page 54, your policy expectations for fixed income. we've talked over the last couple, months where on the short-term basis, your composites have underperformed the benchmark, but on your policy expectations, which are for 5 years, you can see both your core and your non-core have met expectations, beating their benchmark, in both of the public, I say non-core, I'm sorry, old habit, on the public and on the private markets, both have outperformed their benchmarks. With that, the remainder of this report is on specialty or alternative asset classes, which we think is best reported by your specialty consultant.
Does the council have any questions? Thank you. Let's go ahead and move on to the next agenda item. Oh, I apologize. So if we could have, Director Sable and Townsend. And get very discombobulated if I don't have time to do it.
Good morning, Madam Chair. Keith Sable, head of real estate and real returns. With me are Seth Townsend and Rob Coaches for the PMRs. We'll start off with the real estate PMR. That begins on page 63 of your board materials. This quarter was a continuation of prior trends, and so in that respect was negative in terms of total return. Valuation marks were at the margin driving that performance, and it was significantly negative enough to offset the positive income returns over the course of that period. If we look at the Green Street transaction index, it's an index of recent transactions in the market. The cap rates that are indicated by those recent transactions are higher than what characterizes similar properties across the Odyssey space. So that would be an indication of potential for further downward pressure on marks going forward. One key detail that's a potential offset to that negative news is the public REIT space has been up about 15% since the lows of late last year. That would typically be an indication that we're getting toward the tail end of that market revaluation cycle. Those quick comments, I'll hand off to Seth.
Thanks, Keith. So I'm Seth Marcus, partner at Townsend, and we're going to report on two different portfolios for you today. First, we'll talk about the real estate portfolio, and then secondly, my colleague Rob Coaches will talk about the real return portfolio.
And in between those two, we'll pause just in case there are questions on each.
Absolutely. Yeah. A lot of content. We'll try and do time for questions. So this is as of third quarter 2023. So year end, or the closing date was September 2023, and that is typical with private asset classes. You have about a quarter plus lag of getting that performance reported. So we are taking a pretty backwards look if sitting here in February now. But as a reminder, for year-end values, which we'll report to you in about a quarter from now, we do a bit of a deeper dive. So we look at every single investment in your portfolio. We provide a page on each of those, a summary page in your book. So your 800-page book today will be bigger when we do the year-end performance, but we'll do a deeper dive at that point. But focus on third quarter 2023 and starting on page 66 of your diligent materials. This is the fifth consecutive quarter of negative returns out of real estate. And this quarter, we were down 2% on a net basis. And now, while negative on an absolute return, the portfolio did exceed our benchmark, the NFI Odyssey Index benchmark, which is the third column in that chart, by 10 basis points. As highlighted in the chart, over the 1-year period, we were down 9.4%, but also exceeding the benchmark this time by 350 basis points. And lastly, over the longer-term period, you can see the positive performance and also the outperformance over those measurement periods. The quarterly, the annual returns, particularly at this point in the market cycle, do remain volatile. And therefore, it's important to note that our policy goal within our stated policy is to outperform our benchmark over a 5-year time period, taking into account a market cycle. To the point of volatility, and there's a lot of new members around the table, but for those that were here last year, when we reported in February we reported third quarter of 2022, our return was a positive 19.2%. So you can see that volatility over just that 1 year period. At that point, we said that's not sustainable. That's going to change. We're going to give some back, and we obviously did over the last 12 months. So what's driving this performance? The real estate remains an illiquid, and is defined as an illiquid asset class. It's subject to both appraisal valuations, transaction activity. This is just buyers and sellers transacting at a market clearing price. And given the current market environment, the downward valuation adjustments that have been made are negative across real estate over the last year. This is due to the elevated interest rate environment that we're in. Also, limited transaction activity. Buyers and sellers are not agreeing on prices. There's very limited comparable transactions for those appraisers to value our assets. And also just the volatility in the 10-year Treasury over the 2020 year. Lastly, the broader economic conditions have really forced cap rate compression and expansion, which means values are going down throughout just defining these quote-the. As I mentioned, while negative on an absolute basis, that's not a goal of ours. We want to be positive. We want to drive out performance. We're driving positive return. Our portfolio does continue to perform well on a relative basis to our benchmark. And here we show the outperformance, and this is really driven by stock selection we refer to, or manager selection, done so by the SIC here, your staff, Townsend, all in conjunction. This includes strong manager selection, but also property types and sector selections. And another point that Marcia and RVK made is it's not an objective of ours to beat our peers, but it's something that we look at. We like to compare ourselves to others. And it's not in your report here, but we did so on just the real estate portfolio. And relative to peers, and peers do vary by investment strategy, size, vintage year, risk profile, all of the above. Our portfolio ranks right on the border of the top quartile, the second quartile, over the 3-year, the 5-year, the 10-year, about median over the 1-year period. So we do still have a positive peer comparison. I also mentioned last year that our sector weightings and our overweight to core real estate would provide downside protection, and that's what's driving some of our outperformance on a comparable basis to both our peers and the benchmark. As a reminder, in the first 5 years of your portfolio, this is going back to 2004 through 2010-ish, before the current council was in place and staff and Townsend, the portfolio had no core holdings. At that point, we were underperforming significantly because we don't have that downside protection. Today we have it. We're a little bit overweight, frankly, and we look to address that through non-core commitments, one of which we'll bring forward later on today. So I spent a lot of time on that slide. We're going to jump ahead one slide for now, 67 in your materials. And this is one that we've had in here before, but I think it drives home that real estate is the primary component of a real estate return is income. And here you can see on the left-hand side the income return as well as the appreciation return over different vintages, going back to the inception in 2005. So regardless of what was going on in the broader market, valuations were dropping in 2008 during the global financial crisis, during the COVID environment in 2020. You see a slight negative. Today you see a slight negative again on a valuation component. The income has consistently been positive and generated about a 4.4% income return since 2011, in line with the index. You see that on the right-hand side there. But significantly outperforming on a valuation and appreciation standpoint. And that's due to the stock selection and we'll talk a little bit about those underlying components here in just a minute. So I do want to look at slide 68. This is a new slide that we included this quarter. And here we highlight the active management and the positive investment selection within the non-core portfolios, just looking at our closed-end commitments. What we show here is the SIC's vintage year investments noted with that diamond, and also the percentage there is our investments during that vintage, what that IRR has generated, relative to the quartile analysis of all funds that were available during those vintages. So here you can see that we do outperform out of 8 of the 10 vintages above median. There are 2 underperforming vintages. I'll talk about those in a moment. But regardless of the quartile that we're in, we do have positive and strong IRRs across these vintages and consistently performing at that above median level. We always want to know what went wrong. What went wrong in 2013? We're below median there. What went wrong in 2015? We're below median there. So in 2013, we made 4 investments. One of those was a failed retail portfolio investment or a fund investment. The other 3 funds did produce double-digit IRRs, but ultimately couldn't bring up the IRR relative given the single. And then in 2015, we made 3 investments. One of the diversified funds had an overexposure to office. We know office has been challenged, and that drove us below median. As you can see that the other 3 funds all have again, double-digit positive returns. Across that vintage, we delivered a 10.8, where we achieved a 10.8% IRR, but again, it was a strong vintage with a top quartile break, kind of near that high teens level, so it was a strong vintage overall. But those are the 2 underperforming vintages. The last note, we do show 2016 with an asterisk. There's no diamond there. We're not showing any investments. We did make a few investments that vintage, 2 of which were credit funds, which are excluded from this analysis because there's an equity comparison here. And then the third one was a fund that actually didn't start drawing capital until 2017, so it's technically in that 19% IRR for 2017. The last slide I wanted to mention before opening up to questions, jumping ahead to 73. And this gets to the point of sector selection that I've mentioned a number of times. It's not only the sectors or the property types that we're in, but it's also the property types that we're not in. So we've been overweight industrial, we've been overweight the other property types. And other is a very broad category. There's another page in here that shows sort of the breakout of what is in other, but it's non-traditional property types, self-storage, senior housing, student housing, medical office. There's a whole host of sort of non-traditional property types. Those 2 sectors are significantly driving our outsized return. And then even more so, being underweight to office, being underweight to retail is additive to our performance. It's what you do, but it's also what you don't do that's driving our outperformance relative to the index. And when we talk about, I know in past meetings we talked about is this the right benchmark, and we're looking at the different components of that benchmark and why do we keep outperforming. It's partially this. That gray bar on this slide 73 is what the benchmark is invested in. So they are in almost 18% office. And because we're down at 13%, we're going to be outperforming just on a stock selection basis. Lastly, the geographic diversification there. You see a 15% component to ex-US, and we break that down further in that pie chart. It gets a little smaller, I apologize, but about 90%, 95% of our exposure is in developed markets, whether it's US, Europe, or Asia. The benchmark, the index that we use, unfortunately, is a US-only index, so that is, again, we never look to mimic the benchmark. We just use it as a guidepost, and being allocated 15% internationally we do think is appropriate, and has also produced positive contributions here. So I'll stop there. There's a lot more materials in here, but want to make sure that we address any
questions on our real estate. Seeing none, we're going to move on to real return.
I'll just end this off.
Okay, good. So I'm Rob Coaches with the Talented Group, and I'm going to cover the real return portfolio, which is about 12% of the target allocation is 12% of your total investment program. That's almost $5 billion of targeted investment value today. And by the way, my materials start on page 95 in your package. And real return has a lot of characteristics similar to real estate, but it's kind of a collection of a lot of other types of investments. And we like to define real return investments as being primarily hard asset-backed investments, primarily private market, so you're dealing with more illiquid, a lot of closed-end private equity structures to invest in. There's usually some kind of an income component, and there's usually some kind of an inflation hedge. So Real return is meant to be your hedge against inflation, or at least part of your hedge against inflation in your portfolio. And right now, as I said, the target allocation is about $5 billion. Your current market value is around $3.4 billion. This, again, we're going back to September 30, 2023, so we're on a 90-day lag as well. We're reporting third quarter data. There will be some changes in this portfolio because about a $300 million slug of private credit investments are in this portfolio. Those are being pulled out and put into the private credit, consolidated into your private credit portfolio. So on the one hand, that's going to reduce the market value of this part of your portfolio, but it's also going to create some more capacity for new investment going forward. And I'm going to skip to page 99. I hope I have the page numbers correct. And it's interesting, the diversification benefits here. The performance of this portfolio is actually quite strong right now. And I would say strong over the long term, but not without its volatility. So as you can see on the chart in the upper right-hand side of page 99, over the long term, this portfolio has delivered almost a 10% net return since its inception, 9.7% net. And over the last 3 years in particular, it's been driven by a lot of strong value creation in your infrastructure portfolio and your energy portfolio. You can see a dip in performance over the 5 and 10-year periods, and that relates to the energy segment in this portfolio, which, if you recall, back in 2016, 2017, it was a correction in the energy market, and it hit some of your investments in that sector quite hard. I want to skip to page 101 to talk a little bit about the different segments that make up, or the different sectors that make up this part of your portfolio. And roughly 80% of the real return portfolio is what we call real assets. And that bucket of assets consists of 4 different sectors. You have infrastructure is the largest. You've got timber and agriculture investments, and then you've got an energy component as well. And this is all private market investment. And the real return, I should say real asset portion of the portfolio is about $4 billion target, about $3 billion of net asset value as of September 30, 2023. And you can see at the bottom of the page here, we have a variety of sectors that we're investing in, and we have some targets, and we're moving towards basically filling the order on all of those different sectors in your portfolio. The real return and the real assets portfolio are more or less playing a little bit of a catch-up game because the allocation was increased over the last year. And because of private market investing, it usually takes a little longer to get the capital to work. And at the same time, you may have some capital recycled or returned to you while you're making new investments. So if you turn to page 102, we try to show how this real assets portfolio has been built up over time. And a couple of points to take away from this page. One is, in a private market portfolio like this, you want to have good diversification by vintage year. So you don't want to put all your money to work at one time. You want to space out the investments over time. As good as we try to be, we can't predict all the market cycles, especially in a diversified portfolio like this. So it's best to try to even out your investment over time. And what you'll see is over the history of this program, you've been making about 4 to 5 investments per year, roughly putting out around $300 to $400 million per year until the last couple of years. And you'll see on the right-hand side of the chart a little bit of a spike in terms of the commitment level in this program. And that's due to the allocation increase and the growth that you're the beneficiary of in the total investment portfolio. So there's more money to invest for the total investment portfolio, and this part of the investment pie, if you will, got wider or got larger. So we're going to be making more commitments going forward. Last year, we brought to you 5 different funds. They were approved almost $760 million worth of commitments last year. We expect about $850 million worth of commitments this year. So again, increasing the level of commitment going forward based on larger allocation and a larger investment portfolio overall. I want to draw your attention to the gap between the red line and the green line, and this is where I say the portfolio is in a catch-up mode. The red line on this chart represents the level of commitments, the aggregate number of commitments made over time. and the green line represents the net asset value. So as you can see, you have to overcommit in these private market asset classes to build that asset value up, because oftentimes it will take 3 to 5 years for an investment to be fully funded. You'll make a commitment today, but it won't fund for until 3 to 5 years out in total. And then again, you'll have some recycling of capital. You'll have some money returned to you even while the manager is investing up new money. So we're going to be in a position of trying to overcommit here going forward to build that asset value up to your target level. I'm going to skip to page 105 just to talk about diversification in this program and what's in it. And as you can see here, this is, again, the real asset portfolio. The bulk of this portfolio is what we call infrastructure. The second largest wedge in the pie there is our direct energy investments. And then you've got a sundry of other things, agriculture, timber, and some other investments that make up the balance of this portfolio. But the bulk of it is in infrastructure. And infrastructure is somewhat of a loosely defined term in the industry. It's generally speaking, it's a newer sector over the last 10 to 15 years. And it's a sector that seems to be growing in terms of what people refer to or investors refer to as infrastructure. So there are always kind of some new things coming into the asset class. But if you look at the pie chart at the bottom of page 105, it shows the various sectors that the infrastructure portfolio is allocated to. So you've got utilities there, you've got transport investments, that's classic infrastructure of, toll roads and bridges and containers and shipping and that kind of thing. You do have a wedge of energy in the infrastructure portfolio. So again, you've got the direct energy portfolio, which generally is focused on fossil fuels and generally focused on more upstream fossil fuel development, and the infrastructure energy, which is generally focused more on hard asset midstream fossil fuels, so gathering, storage, et cetera, or on more sustainable energy strategies where there's a lot more of a hard asset component. So those are your wind turbines, solar panels, and other types of sustainable energy investments. And then communications is an area that we'll be doing a lot more investing in, I think, going forward. That's all the telecom and a lot of data center type investments go into that wedge of the infrastructure pie. So a lot more in the technology sectors are in that communication wedge. So the point to take away from this slide really is this is a very diversified collection of investment sectors. They all behave a little bit differently. They all have different portfolio attributes. And we'll spend a little bit more time this year with you talking about how all these different sectors are going to be blended together as you move into your structure study and things like that.
Actually, before you move on, there's a couple things. So she just whispered, if you could give us the definition of what social.
Yeah, and this is one of these newer collection of assets that are being thrown into infrastructure. But generally, I would say that they are mostly government-backed assets. So it could be anything from education facilities, healthcare facilities. I don't believe there are any in your portfolio, but there's some folks are investing in prisons and things like that.
So with your portfolio, there's no prisons, but so typically this exposure today is in Europe. We don't have much here in the U.S. They have a much more social infrastructure component. They call it a PPP, public and private partnership, and that's where we're getting a small exposure there. But it is usually hospitals and education. Is really.
Some managers do, for example, student housing at universities. And some infrastructure managers will look at that sector, and they're really competing with some of your real estate managers, type of assets, and that type of thing would fall into that social.
Madam Chair, sorry to interrupt your presentation.
Happy to answer questions.
So is that more like social governance? When you put social media, I'm thinking social media, how does that connect telecom to the telecom communication? So, and then what is in the other bucket?
Yeah. Well, this is, social media has nothing to do with social infrastructure. These are hard assets, basically they're buildings. and they're leased, for some kind of government service.
No, I understand
So,
that now,
yeah.
but the idea of just writing social, looks,
We can
it
change,
could
yeah.
go everywhere. Social
Yeah, okay,
media,
that's a good,
social government,
that's a good
social,
feedback. That's the term that's commonly used in the industry.
and as far as other, what is in that bucket?
Yeah, so other consists of two things here. Again, there are a few, private credit investments in that bucket that are gonna be moved over to the private credit portfolio, but primarily the other is what I like to refer to as more movable infrastructure. So these aren't fixed assets like a building or a storage facility. These are more movable assets, things like, boxcars on trains, containers, things that can pick up and leave and move. And, you have a few investments that target, that sector, and there's a finance sector in the industry that segment of the market. That's what's in the bucket.
Madam Chair, the last time we spoke, we talked about the potential of infrastructure being a little bit more clearly defined, or maybe moved out to a portion so that it's more clear about what that portfolio looks like. Have you thought anything else about that, or was there any guidance that you wanted to give the council on that?
Yeah, go ahead.
Let me take that. Madam Treasurer, we're involved right now in a structure study, and one of the projects that I've enlisted Nino's help on is to look at the universe of public funds, private funds rather, that are in this real asset space, and to break them down into segments that would show the diversification and the ownership levels of our peers on an aggregated basis. And so, kind of the very high level result of that analysis is that if you look at a real asset portfolio, about 80% of that falls under that broad category that you're talking about, infrastructure, and about 20% of that would be in natural resources. And you can split that up between upstream oil and gas, metals and mining, commodity type exposures, and then the agricultural elements, so timber and agricultural lands more broadly. If you take a deeper dive into infrastructure, there's about 6 or 7 key buckets that are very roughly equally weighted. So you'd have one that would be communications, and that would include things like data centers, towers for 5G, fiber, spectrum, those sorts of things. The energy component would be the standard midstream in oil and gas, for example, MLTs and water reclamation types of activities. That would be a somewhat smaller, so communications currently looks like roughly a 20% bucket. The energy midstream, maybe a 10. The social infrastructure piece that we were just speaking about is a mid-single digits like exposure. And again, to Rob's and Seth's point, most of that type of asset is in Europe, and it tends to be held in some of the more mid-cap oriented infrastructure managers. And so as we diversify our book over time, we will probably see that exposure increase a bit. And then another of the more significant buckets is transportation and logistics. So that could be industrial space, highways, airports, ports, things of that nature. And then the last of the buckets would be utilities. So there we're talking water, power, energy transmission. This would be where all the renewable energy production would be, so wind, solar, hydro, and so on and so forth. But that's just the sneak preview, but I think that highlights that within that 80% bucket, there are at least 5 distinct separate categories that we would be.
Actually, just to piggyback off that, because I had a comment I wanted to ask about the structure study, but maybe it's fairly complete. When are you presenting it?
Date is still TBD, so if you have something that you would particularly like to see in there.
Analysis, do you think some of the good work that Donna Gracias has done around looking forward to fossil fuel use and what that demand is gonna be, and just kind of, I don't necessarily want you to crystal ball, but I would love to see your analysis of how you think renewable and sustainable energy sources are gonna look know that we're pretty, I mean, the bulk of our energy investments are fossil fuel investments, correct?
And, yeah, they are to the extent that it's a lot of, midstream exposure. If you look at our oil and gas upstream, currently,
I mean, it's kind of like parsing, you know, I'm just basically saying the electrons generated are renewable versus.
oh, sure, yes,
Okay.
yes, I was talking about with regard to portfolio.
Looking to the future in terms of demand, in terms of, you know, where those industries are headed and where this green transition, I mean, I mentioned it already, and I'll mention it again. You know, the Carbonomics report that was a year ago it came out, just using some of those predictions and numbers to sort of analyze where we should be going with our investments based on where we think demand is headed. Is it possible to add an analysis into this?
We can incorporate that.
And Madam Chair, to add to that, Donna Iglesias is going to be presenting to the council, some modeling that's relevant to this discussion at the council meeting in April. And that also will lead directly into, I think, some strategic planning that the council would want to consider. And our team will actually be reaching out to all of the council members, to look at some potential dates for a strategic planning retreat this summer.
It always seems like Dawn's presentations are standalone, like do they impact our decision-making, is my question, so.
Madam Chair, I think they are about too much more. I think that is the point of the strategic planning retreat, is to take the data and then make decisions, because once she presents it, I think it'll become clear why, politics completely aside, just from an economics perspective, we need to take that into account into how we target our investments.
That was my question.
Yes.
I guess, you know, whether it comes from your structure study or a strategic planning session, it doesn't matter, I
we'll
want
address
us to be looking at that. Okay, I apologize.
Yeah, I do agree. But to your question, I do appreciate that you guys are looking at this, because when you look at the first graph and from the last presentation we had, you can see on that top portion, which, can you make it bigger? I think everyone's okay with not seeing themselves on the big screen. When you look at just that graph,
Yeah.
it was throwing me off last time until you guys explained to me what was going on, that there's a whole other graph, which is below it, that is the breakdown of the infrastructure. And being able to identify what that infrastructure breakdown is a lot more helpful to know that we're diversified within the infrastructure realm. I think for me, to your question, it would be helpful to go into the breakdown when we're just talking about that portion of your structure study. What actually is the percentages within the communication of the things that you're talking about, for example, telecom, data, whatever, on the energy, the midstream, the oil and gas, the water, knowing what the percentage breakdown is of the 26.9% in energy, for me, is helpful to know how that then connects to what the studies are and the data is, so that we know that we're moving in a direction that's statistically and data proven to support the portfolio.
Great point. I think the other,
Yeah, that's a great point, and the one consideration, which is, you know, the practical consideration is when it comes to the actual manager selections and the funds that you select, you know, you have managers that invest in a diversified fashion, so that large global firms that are investing in all of these sectors, and under a private equity type structure, so you make a commitment, and we call that a blind pool commitment, right? You're buying a strategy, you make a commitment, and then the manager goes out over 3 to 5 years and invests. So you don't always know what that manager is going to invest in. They say when they're raising the capital, this is how we're going to allocate the money, but over a 3 to 5 year period, the market changes, they find better opportunities in one sector versus another. So you don't always know exactly what you're going to get with these larger diversified firms. And you also have the opportunity, as the market develops, there are a lot more specialists. Copenhagen was a group we brought in late last year, which focuses on sustainable energy. And that was a nice way to kind of rifle shoot.
Target, yeah.
Yeah, target, you know, investment in that one sector alone. So pulling the information out of your existing investments and then also realizing that you're investing on a blind pool basis there's a practical consideration of breaking them down in a detailed way, and then it changes, it can change relatively quickly based on the level of recycling and smelling and conditions, so.
Madam Chair, a couple questions. Am I reading this correctly, that energy is 24.3%, but we got energy down there at 26.9? Would you add them so that we have 50% in energy?
Not exactly.
Yeah, not quite that much in there, and there's a lot of different types of energy-related investments.
But the quick math is.
Which goes to the question that the chair asked, could we have a breakdown to see what that energy looks like?
Absolutely. So the quick
I
math.
mean, when I read energy, I look at it and I say, oh my gosh, we're in oil and gas.
Yeah, the oil and gas number actually in the portfolio currently is about 5%.
Okay.
And then there's some, midstream that's in the financial assets bucket that in the current breakout that we're using isn't, adequately reflected. That'll be changed during the course of the structure study. If you look at the infrastructure universe, writ large, that would be, about 22%. If you add our MLPs to the current midstream, infrastructure in the portfolio, that number would be about 30.
Okay, one last question. Could we add to a maturity on the investments to this so that we know what the maturities are? Of some of these? Do any of these private, when do you expect them to run out?
Yeah.
So that we know what the cash flow looks like coming back, or what you anticipate that this is gonna run out in 5 years, 10 years, whatever that term of investment's supposed to be.
So most of the funds we invest in have a, 3 to 4 year investment period, 3 to 4 year, value creation period, and 3 to 4 year. 10-year vehicle is what we're investing in. So I know there's two different questions. One is, when are we gonna get in and out? But then the second question is, when is the fuel itself gonna expire? And there's two, so the second part is a little bit more difficult for us to include in the analysis, but we'll give it a shot.
Thank you.
We do, some detailed, we call it pacing analysis, and we work with your team on that in terms of planning out, 5 to 10 years out, how long it's gonna take for these investments to run out and return capital. And that's part of that one slide with the two, the red and the green line. You're always looking ahead to what's coming back and upping your commitment levels to make up capital coming back as well. That's factored in, but.
We have member Alex.
A quick question.
Yeah.
One is, what percentage of the portfolio is international, especially in the infrastructure area? And then, actually, I'm going back to a real estate question, because it's talking about more granularity. How much are we investing in elder housing, assisted living, memory care, kinds of healthcare facilities, which everything I read is huge demand for that, not enough there. So just understanding that level.
Let's take the first one, then I finish, then we go back to the real estate. If you turn to page 106, this is your total real assets portfolio. And what we like to remind the committee is you are predominantly invested in developed markets, over 70% in the U.S., 85% in developed markets around the world. But you do have a fair amount of exposure to Latin America, in particular. And that's really diversified across all these sectors. So you've got timber investments and agriculture investments down in Latin America, as well as infrastructure, allocated across all of those. And that would be the one part of the pie that's a little bit more, if you will, emerging market exposure, so about 15%. And there is detail starting at page 121 of this report, which all of the, we don't want you to go there now, but all of the detail in the last report, it's all there in glorious detail in terms of how each investment is allocated across different markets, including breaking out all the emerging market exposure that you have.
And on the senior housing, so I don't have it in front of me. We can get that. We can follow up with that. So our residential exposure, just like energy, can be broken into at least 4 components. There's senior housing, there's student housing, there's apartments, there's single-family rental housing. Residential is its own category, and there's subsectors to each of those. We have relatively limited exposure today. I don't know the number off the top of my head, but to the senior housing sector. We did have historically a fund that was invested there. It's fully liquidated, so we're out of that. But a lot of we don't have any direct investments in senior housing. To Rob's description of a focused commitment to a single strategy fund. Where we do capture it is in a diversified manner from a diversified fund that does invest across the residential sector. Follow up with that member, Ellen, and go ahead.
Want to just wrap up?
Yeah, that's all.
That's it, okay. Perfect,
Yeah,
all right.
and we appreciate the questions.
Exactly.
It's helpful to have the feedback, so as we flush these out in future reports.
And kind of know where our deficiencies are.
Yeah.
I appreciate it so much, thank you so much. So we're gonna, dismiss these folks and ask, Director Loftus and Nikita to come up for our, QC private debt PR. And it was real helpful, that they gave a little bit of an introduction of themselves, of the consultants, of the asset class, percentages and dollar number.
Sure.
I would appreciate that from your members,
Sure.
actually for myself.
So, thank you, Madam Chair, council members. First off, my name is Tom Lawson, head of fixed income. Fixed income, covers the public, debt markets as well as private debt markets. So this performance report is going to cover the private debt markets portion. I've been with SIC, a little more than 2 years. More than 2 years. So, the first things that Vince asked me, when I joined was, we're going to make the decision on a consultant for the private debt market. It's Mary Bates, her team at Nikita. The second decision he asked me to make was, essentially what changes would I make to the private credit portfolio, and frankly to the fixed income portfolio as a whole. And we made a number of them. I'm sure the council members that have been here prior, I sound a little bit like a broken record, but we made a number of changes. We moved a lot of parts around just to give you an indication. At the time I came in, private credit I think was right around $5-ish billion, something like that. We ended up either redeeming or moving over $1 billion of that portfolio. At the same time, the first pacing study I read was something around $900 million a year, I think it was. Now, and really within 2 years' time, we're $2 billion. So we more than doubled, and at the same time, we've made a significant amount of changes sort of under the hood. In the CIC, or the Council Credit Committee, 1 week ago, Member Ulrich pointed out that it's a little difficult right now because there are so many moving parts. It's a little difficult to kind of understand what exactly is going on in private credit. Are we moving in the right direction or not? I take responsibility for that. There's RBK, which generates our overall performance numbers. There's Nikita, which really focuses on our private credit, and then there's our internal operations. Campillo, who essentially tracks everything and helps me understand our pacing requirements going forward, and getting all those on the same page as far as what investments should be categorized in spots. They're all a little off. That falls on me. But the next time we come around to a performance report, we'll make sure everybody's on the same page so you can kind of do a much better job of understanding where we've been and really where we're trying to go. So joining me on today's, that's probably enough preamble, joining me on today's presentation for private debt performance, Mary Bates from Nikita, and then we have Ted Ferguson, who's online with
hear us?
Yeah. Can you hear me?
Just barely.
Okay, I'll try and speak up. Are you ready for me to take over, Tom?
Okay, that's perfect. I'm gonna turn it over to Mary real quick, and then I'm gonna let Mary turn it over to you, Tad, okay?
Sounds good.
Great, thanks so much. Thanks, Ed, and thank you, Director Lofton. So as mentioned by Tom, my name is Mary Bates. I'm the co-lead of the relationship with New Mexico, and with my colleague Tad Ferguson. Tad is in Portland today. Tad predominantly focuses in terms of a division of responsibilities on the performance reporting, and he'll walk us through this, and then I will be back up to present the Silver Point investment. I'm here to answer any questions that you may have. Ed, do you want to kick us off in terms of the performance report? And just by way of background, both Pat and I are managing principals at Makita Investment Group.
Yeah, good morning, and I apologize for not being there in person. I've actually been under the weather, so you probably appreciate me not being there, but hopefully my voice holds out through this presentation. But as Tom mentioned, Director Lofton mentioned, the program has a lot of in a period of change given the structural review that was conducted early last year. So I'll try and keep my comments to really focus on what is changing, where the program's going, and highlight performance throughout that, but really kind of try and expand upon what those characteristics are that we're trying to incorporate in the portfolio going forward. But overall, I want to start my comments on page 127 on the overview. So as of the end of the third quarter, the program was constructed with $7 billion of commitments across 48 partnerships and had a remaining market value of approximately $2.9 billion. This represents just a little bit over 6% of the total portfolio, so well underweight the long-term target. And that is a function of the restructuring that's been undergoing as there's significant liquidity and distributions coming back and some reallocation of assets that I'll expand upon throughout this discussion. But then also just, as was previously mentioned in the real assets, the larger total portfolio growth has really kind of raised the overall target that we're trying to strive for. So a combination of factors, but currently the program is underweight long-term targets, but there will be material activity going forward to achieve that. But since inception, the program has generated a 5.5% net since inception IRR, and that compares relative to the policy benchmark of the S&P Leveraged Loan Index plus 2%. That was a policy benchmark adopted at the structural review last year. That is in line with that benchmark using a public market equivalent analysis. That's PME, as we have on our table here. And so that calculation assumes the program cash flows being invested in and out of that actual index. So it's really kind of comparing how the program would have done if it was invested exactly in that index. But we also want to highlight, as part of the restructuring, we've targeted 4 primary core strategies that will be the components of the program going forward, and really wanted to highlight what those results would have done on them by themselves. And those sectors have generated a 9.2% since inception IRR and outperformed the policy benchmark, which was a 5.7. But over the next few slides, I will expand upon the new sectors, some of the commitment activity, and the go-forward activities that we are expecting for the overall program.
And Tad, if I could just jump in with a quick comment here, because I think this is such a key point, and we're happy to provide additional background to some of the newer trustees to really flesh out. But your program dates back to 2012. It's gone through a number of iterations, but effectively it was very hedge fund focused. And so we're restructuring the program. A number of the hedge funds are in liquidation, so kind of the underperformance, if you will, relates to a number of the legacy or the liquidating exposures. So we're reorienting the program to focus on private credit, and we'll talk through what that means. And on a go-forward basis, and the program that's in place
is performing in line with expectations, and you can kind of see one of the reasons that we're redeeming from a lot of the hedge funds is they haven't met expectations, but the things that are in place and going forward are meeting expectations. So your go-forward program is performing in line with what we're trying to do, which is to generate net of fees IRR in, say, the 9 to 11 range, and that's what we're doing on a go-forward basis. But we'll continue to have that dispersion of returns, and that's one of the things that we're working closely with RBK on in terms of your broader performance report to capture that. So we're going to have kind of two numbers in all of our reports, kind of the overall, but then kind of this go-forward, which we think is more representative of what the program should do on a go-forward basis. But Ted, do you want to continue?
So on page 128, we highlight a little bit more of what we call the go-forward strategies within the private credit portfolio. And the four core ones, we've outlined targets and ranges around these, but they include direct lending, asset-based, special situations, and diversifying. And as Mary mentioned, we have the liquidating and legacy that are ones that are running off and declining, and historically included hedge funds and more public fixed income type exposures. And just to kind of highlight the amount of change that's happened over the last quarter, as of the end of the second quarter, the liquidating represented approximately 37% of the total, the private credit portfolio. So there's been material activity there, and it's changed relatively quickly. And that's pretty big change for a private market portfolio in a short period of time. But currently, the target allocations and the ranges, these are long-term targets. So it's going to take some time for us to get towards those target and be within those ranges. And the private markets are, slower moving. So it's going to be a combination of committing capital to the underweight strategies and letting some of the other exposures roll off. But it'll be, we will be away from these target allocations over time. And that, we fully aware of that and acknowledge that. But we have really a bottom-up selection process, getting the appropriate partnerships into your portfolio, but striving for those target allocations over the long term. And just to kind of highlight, the diversifying category, which is the largest exposures currently in the portfolio. This is a little bit of a catch-all that for strategies that don't cleanly fit into those top three categories. And so currently in there, this includes, infrastructure debt, some real estate debt, multi-strategy type exposures. So it's, the diversifying is a little bit of a catch-all and can be misnomer, and that's why it's a little bit larger proportions, but we expect more to the direct, the commitments and capital flows to go to the top three strategies going forward. On one page.
Oh, so sorry, Ted, if I could just, one overall comment that I would make, the overall restructuring of the program that we have done is working in concert with Tom and Director Lawson, is to move away from public tradable fixed income to a structure that leverages your size and focuses at the highest level on compounding interest. So yield is meant to be the primary driver of return for your program on a go-forward basis. And because you're a very, very long-dated entity, we're trying to use your time horizon to your greatest advantage and simply compound interest rather than taking a lot of volatility in terms of publicly traded fixed income or try to make a lot of views in terms of capital appreciation strategies. We're just trying to invest in strategies that are yield focused, very downside protection focused, and compound your return over time.
And I would just to chime in, I would add that it was one of the things that when we were looking at Makita and some of their peer groups, something that I really saw eye to eye with Makita on. For the private credit portfolio, we want managers that are making loans to companies and therefore are good underwriters. Don't want this portfolio dominated by managers who are doing a lot of trading. So, frankly, there's purity to that, and we can concentrate on what we know best.
Absolutely. Just one other point, not to belabor this, but I think philosophically, one thing that Tom and Nikita agreed on also is collateral diversification. Private credit is much broader than only corporate credit. So we're trying, again, to leverage your size to invest in strategies that are complementary in terms of collateral. And what we mean by that is investing in things that are backed by assets. In some cases, hard assets like equipment leasing related strategies. In other cases, more soft assets, so like intellectual properties and things that are less physically tangible. But when you combine all of those different types of collateral approaches together, it also promotes greater diversification and downside protection. So, Kat, do you want to continue?
Yeah, so on page 129, we provide a little more color of the performance metrics of each of these strategies since inception. And again, reiterating, if you look at the right-hand column, the IRRs down there, the top four have been much more additive, higher, high single digits, low double-digit type returns. The legacy and liquidating have been more low single digits, have been less additive to the overall portfolio. I just want to reiterate, these are different types of exposure. So this is not a negative statement on the manager selection or the actual partnerships. It was a different role. It's not, it doesn't have a purpose in the go forward strategy of the segment. It's just, so it's not a negative on those exposures. It's just that was the role in the portfolio that is not part of the go forward strategy. And then here, if you just look at the unfunded, you'll see that most of the unfunded commitments are going to be flowing to those top four strategies. So that's, again, reiterating where this program will evolve towards those strategies as more commitments are committed and then other exposures are liquidated and start rolling out of the program. Over the next couple of slides, addresses a little bit more of the commitment activity. And I just want to stop real quickly on page 131. Kind of similar to the comments for the real assets presentation, there has been an increase in annual commitment activity. And there'll continue to be kind of at the go-forward basis, that commitment activity. So in 2022, there was about 1.2 billion of commitments. In 2023, that increased to 1.7 billion. And we're on pace to do a multiple of that going forward. And that's part of the to achieve that higher target. I mentioned the program's underweight, but just expect to see additional, material commitment activity throughout the calendar year in the next couple of years, as we increase, larger bite sizes to each partnership, number of partnerships, as we really are striving to achieve that target allocation, but maintaining vintage year diversification and strategy diversification. So deploying that capital over time, but there is a material increase in activity over the past couple of years. That will take some time to get into the portfolio and evolve those exposures that we've been discussing. And then I just want to kind of finish up on 132 for my formal comments. And this just highlights the activity of the quarter. As I mentioned, this is pretty material. This page looks at the contribution and distribution activity on a quarterly basis. Historically, distributions hadn't gotten up to about 200 million, and for the third quarter, there was almost 1.7 billion of distributions and transfer of market value. So that has really contributed to that underweight to the asset class. But I also really want to highlight that significant change in the program, and this really is evolving program as we are adjusting to meet those strategic targets that we were adopted about 1 year ago in that 2023 fixed income review. But overall, the program continues to be highly diversified. It is an evolving program, as we've discussed in quite a bit, but it's underweight. So expect to see material commitment activity go forward as we just really strive to reach and maintain that target allocation to the private credit asset allocation. But we think that overall, these activities are really positioning the portfolio for outperformance relative to the policy benchmark on a go-forward basis. So I'll pause there to see if there are any additional questions.
All right, next we're going to hear from our PE folks. First is our national program, and then our New Mexico program. We'll call up Director Cassidy and Mercer. And same deal, folks, just a little bit of an overview.
Good morning.
morning. My name is Chris Cassidy. I'm the Director of Private Equity and Venture Capital. And I'm joined by Richard Pugmire and Amy Ridge from Mercer. They're partners at Mercer who help us advise us on both of our portfolios. We're responsible for two portfolios, a diversified private equity portfolio that invests across buyouts, growth equity, venture capital, special situations, and secondaries. A bit of a mouthful there. Basically, we invest, that's a portfolio of effectively mostly private companies. That's what we call the National Private Equity Program. It's a very diversified portfolio. The second program is called the New Mexico Program, which was set up in the early 1990s to attempt to help foster tech transfer and commercialization from the state's research labs and their research institutions or universities. So that program is largely venture capital related to industries that our state has good research in, which includes stuff like deep tech, frontier tech, climate technology, aerospace defense, which we'll talk about a little later. This month we have 7 items. Apologies. We have 2 performance reports, 1 for each program. We have 3 investments for the National Private Equity Program, 2 middle market buyout strategies, which is really the core of the investment strategy for a large private equity portfolio, and a life sciences portfolio that's kind of mid-stage venture, as we describe it. And then on the New Mexico side, we're going to talk to you about the creation of a specific aerospace and defense sub-strategy, which we think makes sense, and 2 commitments in support of this new sub-strategy. So starting on the National Private Equity Program on page 151, on the national program, the program was down 50 basis points in Q3. It compares to 60 basis points from the Burgess Private Equity Index, which includes a mix of private equity or venture capital and buyouts. Basically, it's been a tale of 2 worlds in the private equity world. Venture capital continues to deflate and trade down. Buyouts has been generally more stable. Of the 0.6% drawdown, 2.1% was negative for venture capital, and buyouts is roughly flat. For the 1 year, the portfolio is up 6%, reflecting the fact that we're largely a buyout portfolio at this point. Burgess was up 3.3% for the same period, and it was very different depending on which venture capital was down nearly 9%, and buyouts were up 9%. Before I hand it off to Richard, I think the one thing that our portfolio is kind of different than the market at this point. We did back off late cycle and try to be careful with our commitments. Our portfolio is probably more mature than the index, and we're receiving more distributions than normal. But the ratio of distributions to contributions in the portfolio was 1.4 times. Versus the rest of the industry, which is struggling. Distributions are 0.8 relative to contributions, which is creating some issues in the fundraising market. As a lot of LPs are what's called denominator now. They basically don't have, they're waiting for distributions before they allowing us to mix them.
Chris, good morning. I'm just going to hit on a few slides to give you a high-level understanding of what's going on in the national program, and then happy to answer any questions. So we're covering Q3 performance, and as Chris mentioned, there was a quarterly loss in the portfolio during the quarter. I mean, this was the first quarterly loss that we've seen since last year, Q3 of 2022. But it was relatively small compared to some of the other longer-term performance that we've seen, roughly about a $20 million loss. We continue to be pleased with the private equity portfolio overall. As Chris mentioned, I mean, it's performing well against private equity benchmarks, mainly because of the lower allocation to venture and over allocation to buyout. You look at the longer term performance, that continues to be favorable as well. From a since inception standpoint, if you look at this table on the screen there, one of the reasons why we split it between 2009 and before and 2011 and after is the SIC relaunched with a new strategy to private equity in 2011. So we split the portfolio in those vintage years to help the SIC understand how that strategy has worked out. And you can see in the 2011 and after funds, they've generated a since inception return of 16%.
And the program's overall return, going back to the inception of the program, which is actually in the late 80s, is a 12.3%, which equates to about a $4 billion gain since the inception of the program. And I'm going to skip ahead 2 slides to page 153, which shows more details about the change in performance. The net asset value actually decreased by $66 million during the quarter. There was 2 components that make up that decrease, though. One was the performance that we've talked about. The second one is distributions actually exceeded contributions, which you can see on this chart here. They exceeded by about $47 million, which, you know, that's different than what we saw last quarter, where contributions actually exceeded distributions. But it is kind of an interesting, data point for our portfolio right now, because we are receiving sizable distributions, which have offset some of these capital calls from the newer commitments that we've been making. And so for all of 2023, contributions have exceeded distributions by $65 million. But, you know, that number could be a lot larger if we weren't receiving these distributions back from the maturing portfolio. So I think that's a sign of you know, a healthy portfolio that we're actually seeing managers sell into the market. As far as the loss goes, I mean, when you dig into what was driving the loss, some of the buyout funds have publicly traded positions that, you know, in Q3, the stock price went down and they had to mark to market. But on the gain side, we've actually seen gains across the board from special situations funds, from buyout, from growth, and so we've actually seen a lot of good data points in performance there. I'm going to skip ahead to page 155 and just talk about the benchmarking, how it's done relative to the private markets benchmarks in Burgess. And well, I'll focus on the 2011 and after, since that's the new strategy. Our goal is to be above median, and you can see we're above median in just about every vintage year, except for 2013, which you know, we have some international exposure there, but those funds are still performing over 10%. It's just that is a strong vintage year, so it's not really taking away from the overall performance at all. So that's compared against the private markets benchmarks, and then the next slide actually shows it against public markets. So we do public market equivalent calculations here, which basically takes the cash flows in the report, calculates an internal rate of return so that we can compare it on a like-to-like basis from a calculation standpoint. And you can see compared to the MSCI ACWI benchmark, which is a global benchmark, it includes multiple countries, similar to what we're focusing on in the private equity portfolio. The national programs outperformed by 5.5% over the last 10 years. It's also outperformed the Russell 2000 by 5.3%, which is the smaller companies in the Russell 3000. Compared against the Russell 3000, though, the outperformance shrinks to 0.9%, but really what's been driving the Russell 3000 is large technology companies, which really half of private equity focus more on smaller companies. So I'll conclude my remarks there. Hopefully that gave you a good overview of what's going on, and happy to answer any questions.
On the national. On to agenda item 2H, that's the last of this section here about the New Mexico.
Materials for the New Mexico program performance report start on slide 171. This portfolio, as we discussed, a little more concentrated, so the numbers it's harder to compare meaningfully to the Burgess Venture Capital Index, but the quarter was down 1%. The one-year number was just under 14 negative, which is in line. It's a little worse than the Venture Capital Index, but given the concentration in this portfolio, I'm not sure it's necessarily meaningful. The 2 largest companies in the portfolio represent 36% of the portfolio's NAV still. So as the portfolio is invested in other funds and other companies, that'll over time diversify. It's a little more meaningful to compare with benchmarks. We've invested aggressively over the last year and a half since, you know, to really kind of implement the strategy from the program and take advantage of the liquidity we have. Inclusive of the investments we're recommending this month, we'll have committed nearly $500 million across 13 managers over 2022. You know, the exposure of the program, and as a reminder, this program is within the severance tax fund, which is exposure in terms of net asset value plus unfunded commitment, roughly 8 to 9%, in line with the target of the program, which is 9%. So
All right, thank you. On this slide too, just to give you a brief overview, we break down this slide by the different investment types in the New Mexico program. There's the Catalyst Fund, which is a fund of funds focused on New Mexico-based managers. There's the Co-Investment Fund, which was an initiative that started in 2004 and co-invests alongside managers in New Mexico-based companies. The Recovery Fund, which is a more credit-oriented fund that was done during COVID, and then the fund commitment as well. And we break those between 2008 and before and 2016 and after due to a legislative change where they're not, the legislature changed the requirement, no longer requiring a manager to open an office in New Mexico and staff it with a senior person, so that opened up the number of managers that were interested in the New Mexico program. And so we put that change in there that kind of helped track that, having that wider population of managers to choose from. Like Chris said, there was a slight loss in the quarter, but I think the bigger story is what we talked about last quarter in this program, and it's the markdown in the co-investment funds. And it's been a difficult year overall in the co-investment funds. You can see the one-year return is just about down 22%. And that, as a reminder, that was due to a mark-to-market of a sizable holding due to a new financing round, which caused a decline from the previous valuation. There's two themes with the New Mexico program to keep in mind. One is the venture capital allocation. Like we said, venture capital is more volatile, and so you see that volatility come through in the New Mexico program performance. And then the second thing is the concentration. I mean, this program has historically been very concentrated. At the end of 2018, 75% of the value was concentrated in one manager. We've been able to diversify that down to 38%, but that concentration is still affecting performance. And then as far as the company, the two companies were 64% of value at the end of 2018, and that's now down to 38%. So it does take time. You know, with venture capital, you make the commitments, they get drawn over time, but we are seeing that increased diversification in the program. One thing I wanted to mention too is just some new activities that we've had since we gave the last performance report. On December 5th, Roadrunner Studios officially opened in Albuquerque. There was a large event. I think probably over 100 people attended, maybe over 200 people attended. It was very well attended. They announced the first companies that are actually a part of the venture studio. If you'll recall, this is a portfolio company of Frontier Fund, which you approved a commitment to. And the event was actually attended by a lot of venture capitalists out of the state as well. So we're hoping that that's going to be a good source of company creation that will bring more venture capitalists from outside of the state to invest in New Mexico-based companies. The second one is a more recent commitment that you approved in 2023, which is Antler. They actually hosted their first annual team and portfolio offsite in Santa Fe just last month in January. They brought about 30 Antler founders to New Mexico to talk about how to fundraise, how to go through growth plans. There's also presentations on why locate in New Mexico and some of the advantages of being in New Mexico. They've actually already hired a person who's on the ground full-time in New Mexico looking for companies. So some good progress there.
And they have funded their first New Mexico founder who based in Santa Fe, and another founder who was originally from New Mexico is actually going to move from California back home. A couple early positives in terms of funding founders in that program.
And just due to time, I'll skip ahead to page 175. So that's the performance side of things. We'll talk about the economic development side. So the number of New Mexico-based companies receiving investments is 119. That number has increased by 2 since our last performance report. 3 companies have actually received, three new companies have been added to the New Mexico program over the last 12 months. And you can see that the amount that the SIC has put into these companies is over $385 million now. And then when you look at the funds themselves, which, you know, the funds have other limited partners as well that invest in these companies, that number is over $525 million. And over $14 million is invested over the last year. So that includes both the new companies and then also follow-on investments to existing companies. And then the next page shows the job numbers as well. The jobs have increased over the last quarter. I mean, it's just under 5,000 now to 4,933. And job growth. So what job growth is we look at since inception from the investment, what were the jobs in the company, and then how did those jobs change over the investment on the manager. those jobs appear on 2,271. So I'll conclude my remarks there, and happy to answer any questions.
Education of the new members, it's Member Allen's passion to ensure that we are using this particular program to grow that ecosystem of entrepreneurship and, investment in things for New Mexico, tech and research and development, things like that. So maybe she's gonna talk about that right now.
Well, I just think that we need to look at it and look at what we can do to really help, what the role that the SIC has, and then how we can really help. And it may be more in education than anything in helping our founders here. So I have 3 questions. One, have we invested in any businesses where it's not about job growth, but it's about technology transfer, so that the founder, CEO, and some executives are creating wealth? Second thing is, are there any examples of other state investment council, state investments, where they separate out the rate of return requirements for that versus the general rate of return requirements, so that you're looking at 2 different metrics and one doesn't impact the other? And then the third is, and I'm glad to hear about the events that happened recently in education. I find the founders in the state, what we lack is understanding Series A, Series B funding. How do you get funding? What do you need to look at? Is there a way that we can, a role for the SIC to help either the educational groups or require it of our funds, or even the general funds that we invest in, to bring people into the state to mentor the founders? So 3 different questions. Yeah.
Start on the education side. Like, we are hearing from, as we expand this program and increase the number of managers, the entrepreneurial community and the founders are sponges. They definitely need that guy. Our managers are spending a lot of time on education, not necessarily, even whether or not they decide to invest or not. So it's definitely a need that was something that was needed in the ecosystem, and I think our managers are doing that coaching and point. Probably the best way for it to be done, because they can focus and spend time and hours with these founders directly, and introduce them to people not only in the state but outside the state as well.
On the separate rate of return question, I mean, we want managers that are going to generate a good return. This is a differential return program, so that's why I don't cover the benchmarking, even though it's in the report. We're not looking to necessarily outperform the benchmarks, but we're looking to get a good return from this program. And you want a good return as an economic development, because then that means the companies in New Mexico are performing, and then that attracts even more capital into the state. That's what we've seen from other successful economic development programs, is you get good investors to invest in good companies, and then that becomes a magnet for more capital, and then, the need for a program like the New Mexico program decreases over time, which is ultimately what the goal should be. And then as far as tech transfer goes, we do have managers that are active with the universities. There's one in particular that actually hires student associates at the University of New Mexico to help understand what technology is being done on that campus and evaluate it, lets them present to the partnership about whether that should get investment or not. And so there are managers out there that are quite active in all aspects of, whether it's the national labs, the universities looking at the technologies that are coming out of New Mexico.
Let me going back to the benchmarking. Are we in contact with the other state investment councils, state investment groups, so that we can look at what they're doing and how are we doing comparing to them, or what are some of the best practices? And then the second question, again on the technology transfer, is investing in that tech transfer, and the licensing, helping founders to understand how to license, and then creating programs that brings in large corporations that might. I was part of when I was at Citibank, part of the original creator with Less LMS Labs, and you wanted to shoot yourself afterwards, but it was difficult. And I know there's ways to encourage large corporations to move here. And then the third thing is now that, especially in the areas of AI and cybersecurity, you can work remotely. In fact, most of the employees are remote, and attracting companies to locate people here, because younger people do like to live in New Mexico. So what are we doing in those areas?
One of the challenges we have with the statute identifies New Mexico headquartered companies is what we're focused on. So we have managers that tell us, look, we could probably move operations to New Mexico. We have these high-growing companies, but technically that doesn't count under the statute, in the current guidance that the legislature has given us. So we've focused more on New Mexico headquartered companies right now. But I mean, that's something that you know, an expansion of the program, if the legislature we could. And as far as contacting other, yeah, we talked to quite a number of other states that have programs. I mean, it all depends. You know, some of them will fund it different ways. You know, some use a pension fund, some will use debt to fund it, and so they all have kind of different return requirements. But I think the commonality is, you know, focusing both on return and then also the economic development measures. You know, how much invested capital is coming into the state, how much jobs are being created. You know, and ultimately, you know, we want good companies that are going to stay in New Mexico and grow. I mean, that's the ultimate goal here, is to get some success stories where that will then attract more capital for growth.
I've spoken with a number of, these programs are challenging. Some common narratives I've heard. One, you need to do things that kind of make sense for your ecosystem. And the good and bad, the good and bad about our ecosystem is very unique. Like, we have some, like, places that we can invest that not everybody else has with our deep research base. So that's one good thing. Climate technology is certainly a place that we spend a lot of time on. The other thing is you want it to be flexible, so you don't want to create a bunch of guardrails which are counterproductive to what you're trying to achieve, which is economic activity and job growth. And so a lot of these programs are set up with kind of false guardrails that are, you know, not necessarily achieving what they're should be. And, you know, I'll hint at that with the aerospace defense thing. We get companies to create a bunch of jobs here if they're not technically, where it's an opportunity for the state, where sometimes businesses, just practical reasons, aren't necessarily going to be headquartered here, but it doesn't mean they can't have a huge presence of growth and a rural impact. So we've seen, you know, a number of states have, as they've grown, have actually increased flexibility to make sure that they're casting a wide enough net so that, you know, they're creating the right opportunities. One of the things we're all, you know, you mentioned hybrid work. We're also hearing that too, that companies, some groups are, hybrid work is a norm now, and so it's attracts certain types of talent that that kind of flexibility, being realistic about that, could be helpful too, because hybrid work now is created a situation where a lot of people aren't necessarily, the entire team may not be willing to move to a place, and that's just not just New Mexico. That's
Member Allen, about 5 years ago, we underwent like a strategic study of like markets in the West, or I can't remember exactly where it was, but it was on, you know, like state-run programs. Similar. And that was pre-COVID, so I don't know if any of those, so we looked at best practices, everything that you're asking about, that was part of that study.
I think part of the strategic plan, that this ought to be a big segment of it, and I'm big about benchmarking what others are doing. We may be doing way better than they are, but at least you learn some of the mistakes that they're making. But I will say, like in the cyber world, which is my world, everybody's outsourced. I mean, they're in Israel, they're in India, and they could just as well be in New Mexico. And there's a lot of opportunity, and so maybe we need to look at going back to the legislature and finding a way to carve out that there's a way to attract companies that may not be headquartered here, but would have large operations here, or at least offices. Thank you.
I don't mean to steal anybody's thunder, but I've made a number of suggestions given John's economic development hat that we hear in the community.
Yeah, and Madam Chair and Member Allen, really good point, and yeah, I think we might want to look at potentially endorsing legislation that would change the requirement of companies being headquartered here to instead having a significant economic presence or some sort of language like that. that would definitely give us much more flexibility as to what sorts of companies we could invest in that would be bringing jobs and bringing investment here. Another thing is, historically, we've really just looked at job numbers, but there's so much more to economic impact. And luckily, we have someone here who can model that. Ryan Eustace, who works for us, previously worked for the Economic Development Department, and took the lead on building an extremely complex, detailed model of how all of the companies that the Economic Development Department recruited impacted New Mexico in terms of not just job growth, but economic impact, fiscal impact, and not just to the state, but all the way down to the individual school district level. Really detailed. I think that sort of analysis for us would give us much better insight as to the impacts beyond just jobs that these companies would provide.
And there's another piece on that. I think about biotech, which I know we're doing some investments in that, but to create the ecosystem for that to happen, you need biotech labs, and maybe not always associated with the university, because then they take part of the intellectual property. So some states are creating, they're investing in building those kind of labs just for founders to work in. And I think we just need to be creative about this for this, and again, include that as part of the strategic planning, or have a task force or something that will help us look at that.
Madam Chair, Member Allen, agreed. That's definitely something we should take a much closer look at, either as an entire council or task force reporting back to the council. Related to that also, and going back to what you were saying about education and trying to educate people in the entrepreneurial sector in New Mexico, the Economic Development Department is going to be holding a entrepreneurship summit later this year. And they have asked for our input and feedback, both as to how to design that summit, what would be helpful, but also if we have any contacts from out of state who could provide feedback as to what has worked well elsewhere. So I anticipate us being a key part of helping put that together. They have the funding to do it. We can provide input as to speakers and structure.
And go back to our fund managers that we're investing in, some of the talent there that might come.
Kathy got a commitment from every single one as they sat in front of her. You're gonna come back and help us, aren't you?
I do ask that.
Okay, we're gonna go to the Madam Chair.
Out of the 5, I'm on page 175, out of the 5 that are companies that are no longer located in New Mexico, what percentage of the portfolio is that? And what I'm trying to do is tie that number to page 180, where it says approximately 58% of the remaining value is in New Mexico headquartered companies. So does that mean that the difference is those 5 companies, or
No.
not that simple?
No. When we invest in a fund commitment, they commit to investing whatever your commitment is, or causing others to invest that amount, but they'll also invest in other companies outside of New Mexico as part of that. So that's what you're seeing is, outside of that 58% is those other companies. And some of those companies have performed really well, so they help with the overall return of the program as well. I don't know the exact.
We could come back.
We could get that for you, though.
But I don't have that.
Then, Madam Chair, to Member Allen's point, coming to mind, SIC, have we done any type of work with the Small Business Investment Group, or RITA, for example? RITA now has SunVia, which is going to be the largest transition line, here in New Mexico. So groups like that, I think, are helpful, even if you can't work with them today, keeping those relationships open for tomorrow, or economic development or others. Have we done any of that?
We haven't done any. We definitely talked to SBICs that do that, and we've talked to the SBA too. They're actually, the SBA has had this program for a long time to help support entrepreneurism and providing loans to venture capital funds to do more entrepreneur. So we're familiar with that program, and we meet with everybody that has a potential New Mexico angle, even if it's not a fit right now, for potentially the future.
There's a number of new programs coming out by the SBIC. SBIC likely eventually have an impact on the portfolio. Just that's the reason it's not as public yet, though, so I can't say. But yeah, the answer is you will. I think the federal government is really ways to support, particularly certain particularly, tense climate. I think it's gonna be an increased part of strategies is incorporating that within the strategy itself.
And Madam Chair, if you can go to page 180 on that breakdown, the bucket of financial, what is in that bucket?
So those are financial focused companies, financial services type companies.
Such as, for example,
You know, somebody that services an insurance company, or, you know, banks. I don't think we have any banks in the portfolio, but that category. You know, whether it's technology, yeah.
Technology serving them.
That could be what it is.
So, Madam Chair, I wanted to bring that up because I know Member Allen asked about IT, and that's 51% of the portfolio. At this point, the last question I would ask is on housing. I'm on MSA's board, and I'm on SIC and on RETA, so if you need help with any of those connections, I'd be happy to connect you guys. But with housing, the governor just went to our mortgage MSA meeting, and it's a priority for everyone at this point, and the legislature and the governor just put, I think, 30 million or 50 million into apprenticeship just to help with the construction of housing in New Mexico for 3 different buckets: homelessness, new job growth, and economic, growth coming in, and then people who are already in New Mexico that just can't afford the first-time home buyers amount of the interest rate being so high and the dollar amount, especially here in Santa Fe. So it's definitely a priority on all of our end, and I'm wondering, how are we at SIC helping to invest in that with the money that we have here? What are we looking at, or are we looking at anything regarding housing or the side on the building, the construction? You know, I know last year we had the Housing Investment Trust come down and talk to us about wanting to invest here in New Mexico. That's one example, but not necessarily just in this portfolio, but overall, I guess my question would be to look at in the future, how are we impacting housing in New Mexico? Because that does help us build our economy. It does help us get more businesses here and help build overall, so.
Chair?
Does anyone have a response to that, or?
Probably a larger question. I think that this particular program has a more specific focus on, tech transfer, but.
It does hit on an important point, though, with this program, is it's important to be interconnected with a lot of different things. I mean, this program alone can't make a difference. You know, if there's job creation in this program and there's no housing, that job growth is gonna happen. But it's important to be interconnected.
Just as a point of information, the Santa Fe County has an interesting affordable housing program I've never heard of before. And because housing is so expensive in Santa Fe, it's really important. Under this program, the house that's built will be appraised. The owner will receive 95% of the appraised value. Buyer will qualify for whatever, not all of it, and that buyer will pay what he or she qualifies for, and the county makes up the difference between that and 95% of the appraised value. I think it's something that maybe the state might consider a good idea, but it's limited funding-wise.
We have middle folks.
Yeah.
All right, so, yes.
Just real quick, we've kind of already gone over it, but, as you mentioned, the SBA, at Santa Fe Community College, we're the lead center for the SBA and the Small Business Development Center throughout the state of New Mexico, so, in terms of contacts, I can help there, and so what I'm hearing here is that there's a lot of kind of pieces that are out there doing a lot of the maybe same things, but we need to kind of get a little bit more focused. Maybe it is, but there's always the opportunity for continuous improvement on that. And so, you know, you do have that, and then the universities and colleges are coming up with a lot of tech transfers. In the Council Investment Committee, we talked about a couple of companies that I'm familiar with. One is, Bio, an incredible, story for New Mexico of technology coming out of the labs, coming to Santa Fe Community College, and now setting up in Rio Rancho for a major international, manufacturing of pharmaceuticals, as well as Risk Sense. I was talking to the member in Howland about the founder of that, how he, I remember him when I worked at New Mexico Tech. As an admissions counselor, he was a PhD student in a lab back there, and he developed this company that is just unbelievable. So, it's all happening here, but I think that we could, there's an opportunity here with a lot of new members, new ideas, new leadership, where we can, formulate that real strategic plan and roadmap in a way where, we can just get more organized. But I'll tell you, some companies in New Mexico have a really hard time with local governmental kind of just stumbling blocks and the bureaucracies therein, and that's a big part of it. Because if they can't get up and running quickly, they'll go somewhere else quickly and easily. So all of that, maybe we can get that kind of a focus on it. Focus and diagram of New Mexico program, private equity program growth, and as a hub, and then all of the different spokes in that hub.
All right. So we just spent 2 hours on agenda item 2, and I'm wondering what we could do is flip-flop these projected times here. We're going to go fairly quickly through our, we have 10 investment recommendations today. And what I'm going to ask is that we focus the comments on hearing from our internal staff and our consultants for the bulk of the presentation. If the manager is present, either in person or online, they can make a few comments, but they are here mostly for questions, I think. Because we want to hear from you folks on the bulk of what we are considering today. Have the managers for questions, and then move on, okay? So that's clear. So we're going to spend 35 minutes on 10 votes. Here we go. I will move folks along if it feels like you're telling us you like.
Okay,
Agenda item, sorry about that. Agenda item 3A is our investment committee report. Do we have anything on that you want to?
I will, so, Madam Chair, with, the departure of Member Lavender, I chaired the CIC meeting, and the last CIC meeting, and we went in depth with all of these different matters, and so, other than that, we'll sort of hear the brief presentation of those things, but we did get very involved with, all of the details with each, investment.
Yeah, if you want a deep dive, join the investment committee.
Correct. Yeah, how many hours did we spend on that? It was 4 hours?
I think 4.5.
Okay, we're not gonna do that.
Yeah.
So we're starting with our 2 New Mexico investments, agenda item 3B, Airbus Ventures Fund 4.
I'm going to make just some high-level comments about aerospace and defense and why we think it makes sense to have a specific strategy in the New Mexico program. Then Richard's going to talk about both Airbus and upfront ventures. We're recommending the specific creation of an aerospace and defense sub-strategy in the New Mexico program, kind of into the world that we want to be successful at it. Similar to climate technology, where we created a similar sub-strategy in September. We see enough evidence that the state has the right ingredients with the important ecosystem. On page 198, I talk about some of the infrastructure and resources that the state has, and I also walk through a number of aerospace and defense companies that started here and headquartered here, like Crossbow Systems, or have significant operations in New Mexico, such as Universal Hydrogen, who are headquartered elsewhere but are expanding in New Mexico. And as we discussed a lot, while we have some of the ingredients, we don't have everything, and we're trying to learn what has worked elsewhere in places like Los Angeles, which has become one of the epicenters of the hard tech ecosystem nationally and globally because of companies like SpaceX and Amazon, which are based. first two proposed commitments this month, they attack the problem from a different angle. The first investment, we're here with Nicole Connor from Airbus Ventures. It's to a venture firm with a strategic relationship with Airbus Airbus SE, that is obviously one of the and the second is to a venture firm with deep roots in LA, and we'll look to help our ecosystem connect with LA, which has become one.
All right, and as you probably have guessed from the name, Airbus Ventures is related to Airbus, the large aerospace company. They started as the corporate venture capital arm of Airbus, but now they essentially operate as an independent firm while maintaining that strategic relationship with Airbus. And they've also have strategic relationships with a number of other limited partners in the aerospace and defense industries. They have raised outside capital from investors in their previous fund, and then also raising this fund from outside investors. And I mean, we really like this for a couple of reasons. I mean, one is, as we started digging in further, the connections, like I mentioned, are important to the New Mexico program. You could have a great technology, a great company, but if nobody's looking at it, then it's really for naught. And Airbus has the connections to bring people in. They also, the team themselves are also very experienced. A lot of them come from Airbus in different capacities. So we really like the operating and technical expertise that they've had, and they've actually been able to build a unique positioning in the venture capital ecosystem over a short period of time with that experience, with some high-profile venture capitalists. From a strategy perspective, Airbus seeks companies in that seed to Series B category. They have a wide network to generate deal leads, which we like. And then post-investment, they do work closely with the founders or management teams across various initiatives, whether it's recruiting talent, because they have deep networks in the industries, market research, marketing, and financing. From a performance perspective, they don't have as long of a track record as some of the other funds that you see us bring, but, Fund 3, which is the most relevant for the current team, is doing well. And they've actually already had a sizable realization to date there, and it's tracking above median. The terms are average compared to other venture capital firms, and they've actually been active in New Mexico. They've invested in 2 companies with a sizable presence in New Mexico, and that's brought them to the state for multiple visits, and they're currently tracking a pipeline of multiple New Mexico-based companies for potential. We're recommending a $20 million commitment to the fund.
The top salient points. We appreciate you being here with us.
Yes, absolutely. Understood that it was a long morning for everyone. Thank you so much for allowing me some time today. I will defer to Madam Chair's request on sort of keeping it short. I think I'll just highlight a few key things on how we view aerospace and defense, and really where we're focused is on the technologies that we think will disrupt aerospace and defense. And that's a key reason for New Mexico as well. We're investing in companies that are working on quantum computing, sensing, and networking, connectivity, new materials, and relevant to some of our earlier conversations today, electrification, the low-carbon economy. And so when we are looking at the areas of investment that when thinking more broadly about this potential sub-strategy within New Mexico, I think it's encompassing all of the other resources that you have, many rich aerospace resources, but also the national labs. But I mean, for us, New Mexico was an obvious option when our portfolio companies were looking to find locations to build their industrial footprint here, like Spin Launch, like Universal Hydrogen, using Spaceport, using Sunport, with 3 national labs, 3 Air Force bases, 15,000 miles of restricted airspace. It's an incredible ecosystem that we think just requires a few additional elements, and that's really having venture capital funds that have that expertise in aerospace and defense. And so happy to take questions instead of going on further.
That's perfect.
Great. Based on the recommendation of the council.
Whoa.
All right, go. Yeah, this one really is kind of. Are we ready? Yes. Consultant Mercer, SIC staff and general fiduciary oversight of RBK. I move that the State Investment Council approve a commitment of up to $20 million to Airbus Ventures Fund for LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, we've got a proper motion by the state treasurer, a second by member Tejas. Discussion on the motion before us? Further discussion on the motion before us? Seeing none, we're gonna take a roll call vote on a $20 million investment to Aerospace Ventures.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Probst.
Yes.
Dick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt Summer.
Yes.
11 or 10 in the affirmative, motion passes.
Very good, thank you so much for being with us today. All right, we're gonna move on now to agenda item C, upfront 8. Same type of deal, that was perfect.
All right, I'll begin, Madam Chair, because he gave his introduction to both before. But Upfront Ventures, they're a well-established venture capital firm. They actually started in 1996. They have a technology focus, which also includes deep technology, which is complementary to the New Mexico program. You know, I think one of the goals that we want in the program is bringing experienced venture capitalists into the ecosystem and spend time looking at new investments, providing that mentorship to the entrepreneurs that they meet with, in addition to the capital. And Upfront is based in Southern California. They have a strong presence in Los Angeles, where a lot of the space and aerospace venture capital investments are currently being made. And so part of the thesis behind this investment is creating more connections between New Mexico and Southern California, where a lot of the venture capital dollars are going. The firm's goal is to really make direct investments in companies and then attract that follow-on capital to generate that economic development. Upfront's led by managing partner Mark Suster, who's actually on the Zoom call as well. And he's been with the firm since 2007, and they also have six partners, including Nick Kim, who's here with us today. In addition to the investment expertise, Upfront has built a team of platform professionals to help companies in the areas of talent, marketing, business development, legal. So this gets to the point of it's more than just the capital. It's also professionalizing companies. The fund strategy focuses on primarily seed and Series A investments, and post-investment they take a hands-on approach, which we like with these management teams in building the portfolio companies. From a performance perspective, the firm's generated favorable realizations with above median measures in a majority of their funds. They've also been able to identify several strong performing companies with more than 10 times returns, which is what we like to see with venture capital firms. Terms are somewhat favorable compared to other long-established venture capital firms that we see, with a higher than average GP commitment, which is an aspect we like to see. So we're recommending an up to $50 million commitment to Upfront 8. I turn it over to Nick.
Cool. And Mark is also on the phone with me. Thank you for having me here today. Again, I'll try to keep it short and keep the comments, to truncate my comments. I think that the thing I'll focus on is how this developed in LA and why we believe this could be the beginning of a really important time for New Mexico. So the JPL was started in Los Angeles at Caltech back in the 1930s, and over the course of that history to today, a lot of the aerospace primes were developed in LA, in Southern California, because of the research and development that was happening there at that lab. That is responsible for a lot of the aerospace and defense technology that you all know about today. And SpaceX, being started in 2002 in LA, was a reflection of Elon Musk realizing that at that time. Since then, what we've seen in LA is a tremendous amount of entrepreneurial activity, because what that company has done is drawn the entrepreneurial spirit out of that ecosystem and said, early-stage companies can be built here. They can go focus on aerospace and defense and create tremendous amounts of value. We've seen that now with Anduril as sort of the next iteration of that in LA. New Mexico has a lot of the familiar things. Nicole shared a lot of that here. You have the national labs, you have the research universities, you have the talent, you have the early signs of great startups that are started here, and that is the beginning of what can be a tremendous amount of entrepreneurial activity, and we would love to be a part of it. That's why we're so excited about this mission.
Hi.
Hi.
So have we worked with this one before?
So this is a new relationship.
This is a newer one. I think I want to phrase this question. Based on, let's talk about like risk. You have two main people that have left you all, and the structure of this puts most of the burden on us. Explain to me why we should do that.
Let me make sure I understand the question, and I'll also, Mark was was here for a lot longer than I've been, so he has more history on the two people who have left.
Okay.
But Mark, do you want to jump in before I?
I'm sorry. Could I just hear the question?
Yeah. So, based on the commitment and seeing that two major people have left the firm, we're putting in a lot more of our skin in the game. Can you explain to me why we should do this?
Okay, sure. I appreciate the question. Listen, I heard specifically today a lot of questions about and comments about mentorship, education, apprenticeship, internships, the goal of creating jobs. Upfront has been around since 1996. When we started Upfront Ventures in the city of Los Angeles, a lot of people were skeptical about LA. They were skeptical because most of the innovation in our sector was being driven from San Francisco or from Boston. If you fast forward just 15 years, we're now the third largest venture capital ecosystem in the country. We are the fastest growing. We're the number one in investments in aerospace, in healthcare, in video games, and we graduate more engineers in Los Angeles than anywhere else in the country. One of the things that we've done in LA is we have focused on community building, tying together government, education, finance with founders. And the second thing related to community building is publicly evangelizing to help attract more capital and more founders. So in fact, the reason I'm in Los Angeles today is I'm about to host a 3-day event where we've attracted more than 1,000 venture capitalists, LPs, and founders from all over the world to come to LA and to spend time with the community in LA. What happens when people travel to a city like Los Angeles is they tend to see the magic of what we have here and want to put more investment dollars into that community. That's the skill that we hope to bring to New Mexico, to transfer some of the skills in mentorship, education, evangelism, especially in the area of aerospace and defense. So that's really what I think we bring to the table. You asked a very specific question about two partners leaving Upfront. I will tell you the overwhelming majority of the partnership at Upfront has been here for a very long time. This is my 18th year at Upfront. The co-managing partner, it is his 11th year at Upfront. Our healthcare lead investment partner, Kevin Zhang, is in his 12th year at Upfront. We have an incredibly stable partnership, and we've all worked together for a very long period of time. The founder of Upfront has been 26 years, and I have worked with him for 26 years. So I think there's a lot of stability and continuity that we bring to bear.
Madam Chair, thank you, sir.
Madam Chair, based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary Oversight of RVK, I move that the State Investment Council approve a commitment of up to $50 million to Upfront 8 LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and condition, and completion of appropriate paperwork.
Second.
Okay, we've got a proper motion by member Tiff, second by member Swinner. Any discussion on the motion before us? All right, we're going to take a roll call vote into a $50 million investment.
Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt Summer.
Yes.
And in the affirmative, motion passes.
Thank you all.
Hang on with us, folks joining us online. All right, next we'll invite up, Oh, we're sticking with the same because we've got some national events. Okay, so agenda item 3D, and we'll have SK Capital Partners.
Yeah, sure, couldn't be in there.
And I'm being told that it's, a new relationship.
So I'll just make some high-level comments similar to what I did for the New Mexico program. The first two commitments are to middle market buyout funds. The fundraising market has been a little difficult, I think is the polite way to put it. So we're getting the opportunity to look at funds that are in some cases already out of the J curve, where some of the blind pool risk is reduced because they've already made a number of investments. Both SK Capital and Brightstar fit this. Regarding Brightstar specifically, I would just point you to page 293, which gives you some numbers of, I apologize, SK. Page 293 talks about some of the investments and where they're currently marked. So this particular investment is an opportunity to already out of the J curve and then a positive return there. That's one to Amy for more detail.
Great, thank you. And Amy Rich, quick intro. I know it's my first time speaking today. I co-lead with Richard on the private equity team, and then I also assist Keith with some of the natural resources investments. So you'll see me back up with him a little later today. So SK Capital Partners, our report starts on page 304 of your materials. This is a new manager relationship for the national private equity program and would fit into the buyout category of the portfolio. We are very select on adding new managers to the portfolio. We look at it both for strong manager names, but also strategic fit. And middle market buyout, you look at buyout as a big category, but there's really subdivisions underneath it. One of the areas that Mercer and staff spend a lot of time in is trying to build that small and mid-market buyout space, because you find a lot of the mid-market move up and that you have to continuously replenish that. So we're really excited to actually add some middle market exposure to your buyout portfolio. They've been, a long track record, over 15 years. They have a large team, including 9 managing directors. And they're a sector specialist, which we like, not a generalist, so they know the sectors that they're investing in really well. They also are very operationally focused, and as we look ahead into market potential downturns and volatility, having operational expertise in-house is increasingly important. It's something that we're really prioritizing as we're looking at managers, because we need to know if something does happen, that they have the ability to go in and improve it, and fix some of the things that can happen during downturns. So we like that add as well to your portfolio. Performance has been largely above median, and the opportunistic piece is what Chris just mentioned. They've already invested about $1 billion from the fund that you're going to go into. It's already marked up, so you're going to see, when we looked at that NAV bridge, it's going to be immediate additive to the gain in your portfolio, but you're buying in at cost, so you're not having to pay for that markup. And then they are anticipating to have a large distribution in the next 2 months. So not only that, but DPI, which is very important as well. Right now, we're really monitoring DPI. So not only are you going to have immediate markup, but capital return to you shortly. So we think that this is a really opportunistic, we're coming in, Mercer first underwrote this in 2022 when they launched, and we have been closely monitoring them ever since. We've had multiple meetings, understood what they've been investing in, and so now we're coming in at the final close, but we think we've actually really helped some risk mitigation in not doing it, but actually watching how they've progressed the portfolio. So we're recommending up to $100 million to SK Capital Partners 6, and I'll turn it over to SK for just a few brief comments.
Maybe just first introduce ourselves. I'm Ben Dillon. I'm a managing director.
Jack Norris, also a managing director and on the executive committee of the firm.
Yeah, so I think you said it well. We're a very focused manager. Everything we would look to acquire on your behalf are businesses that we understand really well. concentrate our efforts. Every deal, every investment we make is really a discussion not just around risk and return, but risk, resource, and return, because we work very closely with these businesses. Same team, doing the same thing for 20 years. So, keeping with the trend of people moving through this quickly, I don't know if there's anything Jack want to elaborate on now, or should we focus on questions that might come from the group?
Can you talk about Fund 5 performance? We're in Fund 6 now, but.
Yeah. Yeah, so, you know, Fund 5 is behind our targets, to be clear. A number of the companies had, exposure to, spend markets that in the last couple of years have undergone some pullback. Some of it GDP related, some of it, from the aftershocks of COVID, where supply chains had a lot of excess, supply in them, and we've seen, pretty significant destocking across certain end markets. So, we have been very hands-on with the portfolio. We do have the resources internally to work with portfolio companies through those challenging times. We're working our way through it, and we're seeing destocking largely completed, and seeing it as we hit 2024, some rebound in some of those markets that have been afflicted by that. So we're optimistic in a return to our normal operating performance across Fund 5 as we move forward. But 23 is a challenging year, no doubt.
So how is Fund 6?
I think it's different in a number of respects. Well, one is from a timing perspective, right? We've been deployed Fund 6 over largely the course of 2023. Different environment. Many of the risks that 2005 experience had been evident, right? Interest rates, inflation, destocking, as I already mentioned. It's also very different from an end market exposure standpoint. Not subject to the same types of exposures, namely a lot of European exposure in Fund 5, which subjected Fund 5 portfolio companies in some cases to higher energy costs and more pronounced GDP headwinds. So end market exposure is much more diverse. It has exposure to end markets that Fund 5 didn't have exposure into. And as has been noted, it's off to a fabulous start, and we're seeing opportunities to deploy capital in a real advantageous way with, again, the risk being more evident, but also the 5 deals that are in Fund 6 have all been directly negotiated, as opposed to having to go through more broad auction style deals. So we're excited about what's in place. We have a robust portfolio, and we're excited about deploying the balance of Fund 6.
I have one. Yeah. Can't help but notice in the makeup of your team, you have 12 directors, and they're all men and they're all white. And so when we're looking at diversity, and you're looking at 75% of New Mexico is diverse, what is your plan or strategy to diversify your team as much as to diversify the portfolio?
So, look, DEI is an important topic to SK, but obviously to our constituents, right? It's broadly defined. We do have broad gender diversity among the portfolio companies, also within the firm. You noted directors and above, but there are a number of people that don't have that title, but are very important to the firm that are gender diverse, and including our CHRO, including our head of sustainability, which is a position that's been added to the firm in the last couple of years. I would also note that our 2 co-founders, I would not define as you did. They both were born in Iraq. So I think we look for diversity in all shapes and sizes, and it's something that is an important element to SK. And if you look at our younger ranks within our investment team, you'll see more gender diversity there. And they're going to have to be homegrown. It's hard to hire somebody as a senior investment professional, as a managing director, let's say. There's not a lot of turnover into SK at those levels. That's not how we hire. We prefer to homegrow our talent. And if you look, there's a number of investment professionals that that are, let's say, women. So, you know, it's something we're working on. We're not where we want to be or need to be, but it is a focus.
Based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $100 million to SK Capital Partners, Roman numeral 6 LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I'll second the motion.
Okay, we've got a member, motion by member Summer, a second by member, Allen, and the state treasurer. Do we have discussion on the motion? Roll call vote on the motion?
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Probst.
Yes.
Nick Tejas. Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt Sommer.
Yes.
9 in the affirmative. Motion passes.
Okay, thank you, and thank you all so much for
Thank you.
Thanks. All right, so this is the final in our, private equity votes today. James Capital Life Sciences on 4.
Madam Chair, Bright Star Capital.
Oh, did I skip one?
Yeah.
Yep. All right, we're on agenda item 3E. My apologies. Bright Star Capital Partners.
So similar preamble, middle market buyout, this is another new manager that we're bringing, again, because we try to fill that middle market buyout, diversification with the buyout. So middle market manager, new manager for the national program will fit into the buyout category. This fund is newer than SK. They were founded in 2015. We have known the founder and many of the partners for a very long time, though, from their predecessor firm where they were senior leaders. And so this is one of those stories where we knew somebody at a firm there over 10 years, then decided to spin out and start their own firm. And we were impressed with what they had done as a team at the previous firm, and so we wanted to continue to back them. And so we have, Mercer has been watching them through this entire kind of spin out and build. And then today, they are here presenting their third fund. This is another, so four sectors of focus. So again, not diversified, but we really like that sector knowledge. Business services, consumer services, industrial services, government services. And similar story, they are really looking to grow these companies through operational growth. And that's really, they're very focused on organic growth. So while they'll do some add-on acquisitions and gain some scale from inorganic, very focused on finding multiple levers of growth because they're buying these small companies and really trying to expand and grow them to a larger scale. The other thing that's really interesting about them is they are very thoughtful about the exit the day they make an investment. So when we were looking at a lot of their analysis and reports, not only are they focused on what are the value levers that we're going to execute in the 5-year plan, but who is the top 5 to 7 exit targets? And let's make sure that our value creation is geared towards where we think the highest exit probability is. And so with that in mind, we like how they are operationally growing these in a very thoughtful and exit-focused way. They've invested 2 funds, still early. They only have 1 full realization. They have done a couple partial realizations as well. And for Fund 3, the fund that you are looking at today, they have already started to deploy capital. So, you know, elongated fundraising, which is nice because not only do you get capital in the ground, you're not waiting as long to get your capital deployed, which is great for your pacing. But also, we get to spend some time and understand the companies in the portfolio. So they have already made 4 investments. And so we are recommending up to a $75 million commitment to Bright Star Capital Partners 3. And happy to let the Bright Star team make a couple comments.
Thank you very much. I'm Andrew Weinberg, founder and CEO of Bright Star Capital, joined by Peter Smith, our head of investor relations. Thank you for inviting me to present today. When I founded Brightstar about a decade ago, I've been doing this for about 25 years, and many of us as a team have worked together for more than 20 years. In fact, two of our partners got their degrees in New Mexico, one at New Mexico Institute of Technology, one at the New Mexico Military Institute. So we're very familiar, and we actually have a number of businesses in our pipeline that bring us to New Mexico on an operational basis. I founded the firm on the backdrop of there are a lot of great families, founders, and entrepreneurs who own businesses who need a capital partner to solve that next generation issue. There are three pillars for us. One is differentiated sourcing and really pulling on that network of family businesses out there. And again, it's about an $80 trillion market for the next generation. Number two, as Mercer talked about, the value creation. Most of us are both investors and operators in one. And so have that experience to bring to those families. I'll give you a specific example in a second. The third is the us and us. We really want alignment among our stakeholders. We'll talk about what that means for ownership of our portfolio companies. But the specific example is another realization since we've last talked, which is we exited our Bobcat dealerships. We own the second largest network of Bobcat dealers in the country and sold that about 2 weeks ago to a family office. And it started with an entrepreneur who didn't have succession planning, but a great vision for the business, wanted to be an ongoing owner in that business, and entrusted us to take over essentially his legacy. We tripled the size of that business. We focused that business on the parts and service business, which was critical to keep that compact equipment up and running. And we turned what was an owner into 50 owners at the company. Therefore, as you've talked about today in other matters, building an ecosystem that didn't exist. So by turning an employee into an owner, we're now going to create another generation of ownership past them. Again, we exited that business. We're very focused on DPI and returning capital. Our Fund 1 has returned more than the capital in its fund, and our Fund 2 is well on its way to returning all the capital in this year, which is about 4.5 years from inception. So we take your J curve, we take the capital very seriously. As discussed, Fund 3 is pre-seeded, and we look forward to building a long-term relationship with you, and I'm happy to answer any questions.
We appreciate you being with us today, and I noticed that there are a number of places that your ESG focus on ESG principles for investments and for how you run your company are brought up in our materials. So
Yes.
That must have caught the consultant's eye. That is something that continues to be emphasized, and that's something that some members here very much appreciate.
Thank you for those comments.
Okay. Further questions?
Right, based on the,
We've got a motion.
all right, based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million to Brightstar Capital Partners, Fund 3 LP, subject to and contingent upon New Mexico legal requirements. New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, we've got a proper motion by Member Allen and second by Member Summer. We have discussion on the motion before the council. Hearing none, we're going to take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer, Laura Montoya.
Yes.
CFA Secretary Wayne Frost.
Yes.
Nick Tejas. Yes. Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt Sommer.
Yes.
10 in the affirmative, motion passes.
Thank you for your time. Thank you.
All right, now we can call a bid.
Madam Chair, before they begin, I've got a hearing that I gotta prepare for this afternoon, so I have to excuse myself. Thank you. Good to see you.
Take care.
Talk to you on Monday.
Great. Madam Chair, so Bain is an existing relationship in the portfolio, although this fund line is a new fund line in the national program. Just to give you a sense of Bain, in aggregate, the strategies that you've committed to at Bain have generated a 15% net IRR as of September 30th, 2023, although many of these funds are still relatively young. This is an interesting space. You know, there's a lot of opportunity now, which is, you know, why we spent some time on it and digging in. I mean, they really focus on several sectors within life sciences, including biopharmaceuticals, medical devices, diagnostics, and life science technologies. They really focus on companies that want to meet the unmet needs that can improve patients' lives. And Bain started this strategy in 2016, and it's led by 4 partners. And we really like that these 4 partners, that the team that they built, the 4 partners and the team around them, have a mix of investing, medical, scientific, consulting, and operational experience. One of the hallmarks of Bain that also applies to this strategy as well is the fund strategy has a strong operational focus. So that is help that's provided to companies in both strategic and business matters, which we like. They typically focus on companies in the later stages of development, which is the clinical and early commercial stages. They do have a flexible mandate, which we like. So they may provide growth capital to a company that just needs capital to grow. They might find a company that needs to pivot and utilize their capital and expertise to do so. But their platform is well adept to assisting companies in multiple types of situations. The team is out there actively sourcing deals, and they can use the broader Bain network to actually source deals. Performance has been above median in the prior funds across most of the measures, and against broader technology benchmarks, where this is a period where software has been performing quite strongly. There's also been realizations at attractive multiples, which is also favorable. They do take some public positions, which can add some volatility, like we talked about in the national program with the markets on a quarterly basis, but they have that experience of investing in public positions, so we were comfortable with that. And from a term standpoint, the terms are fairly average compared to similar funds, except they do make a pretty sizable commitment from the team and the firm. Probably one of the larger commitments that you'll see from a fund that we bring. So we're recommending up to $75 million commitment to Bain Capital Life Sciences Fund 4, and I'll turn it over to the team. So brief remarks.
Thank you, Richard. I'd just like to kick off and thank the investment council members for your time this morning and for your partnership. Thank you very much. It's an honor to be here today. I'm joined by my colleague, Steve Radakovich, who's a partner in our investor relations team. My name is Amir Zamani. I'm a managing director in Bain Capital's Life Sciences Fund. I've been with the firm for about 6 years. Prior to that, I was a partner at McKinsey & Company in their life sciences practice, working with biopharmaceutical and medical device companies. And prior to that, I trained as a physician at Johns Hopkins and trained as a surgeon at the University of Pennsylvania. I think Richard did a great job of hitting on a lot of key points. I just want to maybe double down on one point as to what's really unique about our strategy and how our team is purpose-built to address that. So our strategy focuses on really 3 questions in any investment we look at. Will a drug or device work in the trial that we are underwriting? How much will it sell? And what's that worth? Very simply. So will the trial work? Once it's commercial, is it going to get regulatory approval? Payers are going to pay for it. Physicians are going to want to use it. Patients are going to want to try it. And then what's that worth? Working backwards from what do we think the size of the prize is and what's the risk return we're trying to underwrite? Our team is purpose-built to address those questions. So we have folks with backgrounds like mine, where folks are clinicians or scientists with public or private market investment experience, with operating experience at C-suite, both in small private companies, but also in larger companies that could actually be acquirers of our portfolio companies. So that's what we think makes our strategy special in terms of where we focus and how we've constructed our team to deliver on what Richard said. So I'll pause there and open the floor for any questions.
I appreciate that. Questions? All right, do we have a motion?
It's up to me. Based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RBK, move that the State Investment Council approve a commitment of up to $75 million to Bain Capital Life Sciences Fund 4, LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Do we have a second? All right, we've got a motion by Member Messina, we've got a second by our DSA Secretary Croft. Any discussion on the motion before the committee, before the council? Discussion, we will take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
Kurt left, that's 9 in the affirmative.
Okay.
Motion passes.
Okay, thank you so much. Director Cassidy, you are dismissed. That was a long one for you. All right, we're gonna call up, next, I believe Director Sable. Townsend, your agenda item 3G, Aries European Property Enhancement Partners.
So, Madam Chair,
Did the seat warm for you there?
You did.
We're all over. All right, Director Sable. And you heard what I said?
I did. So, Madam Chair, I'm joined by the usual band of suspects from Townsend, and I have Avi Gandhi and Wilson Lamont, the co-head of European real estate for the Ares portfolio. This is a re-up investment, which means it's the next fund in the sequence of funds that we already have exposure to. We're recommending a €200 million investment in European Property Enhancement Partners for, as I said, it's a re-up. We have $75 million in the prior vintage and $250 million across 3 other funds in a related series. Strategy of the portfolio is a value-add strategy focused on industrial and residential, with a focus on Western European cities. The fund's target return is in the 10 to 12% return range. In terms of fit, we appreciate the management team's conservative approach to value-add investing. In particular, we think they emphasize the largest, most liquid markets in Europe rather than seeking higher returns in the periphery. And secondarily, they use leverage and development strategies to a lesser extent than many peers in the market. The fact that they're investing in a lower risk, lower return portion of the market generally causes some of their peer rankings in a quantile structure to come up middling. And so I had the Ares quant team help me with an analysis, a direct alpha analysis. They used an alternate benchmark. We picked the Odyssey because that's the benchmark for the overall portfolio. Levered that up to account for the differential leverage, and even on that basis, the portfolio returned several hundred basis points of direct alpha, so returns in excess of the expectations based on that benchmark. On balance, staff used the fund as a solid, steady performer. It's conservatively managed and appropriately priced for the risk profile.
I don't have a lot to add. The strategy's in here and consistent with the past strategy. The team is the same and consistent. Keith has gone through the performance and the ranking of them. The one thing I'll say about just portfolio construction is that in our portfolio, we have a combination of both high alpha, higher octane European investments, where this comes in at the lower level of that spectrum. So to help balance out our risk profile within the overall portfolio construction mechanics is another reason that we want and support the Ares platform within the portfolio. So I'll stop there. Wilson and the Ares team is here to answer any questions or provide any other context.
Great, thank you guys. My name is Wilson Lamont. I am co-head of our European real estate team. I have been with the team now for a little over 20 years. First of all, thank you for inviting me here today. This is a continuation, I hope, of a near 10-year relationship between yourselves and my firm, which we're very, very grateful for. What I hope you see from our materials and the information we provided on the fund and the firm is a story of continuity. Ares continues to grow and prosper as a business. Today we have a little under $400 billion of client capital under management, and we continue to build out the platform to service that capital. From a European team and platform perspective, again, It's continuity over a long period of time. I've been with the business, as I say, for over 20 years. I have my partner in crime as co-head of the business has been also with the firm for that same period of time. And we have many of our team that are with us for in excess of 10 years. We continue to invest in the team with over 70 real estate professionals covering the markets today from London, Frankfurt, Madrid, and Paris. The team have touched on, Keith and Seth have touched on the fund strategy. We do believe that the EPEP strategy is an appropriate risk return for the European markets. Today, what has changed in the markets is that we are looking at a very significantly different investing landscape from where we were several years ago. Your meeting this morning has talked a lot about inflation, interest rates, bond yields. We have seen the major impact here in real estate cap rates as well. And when we look at the European real estate markets today, there has been a significant decline in value, probably greater than what you've experienced here in the US. And so from a cyclical moment in time, from our real estate markets perspective, we feel that going forward today is going to be a good vintage to invest in, with many of the underlying real estate fundamentals around supply, demand, rental growth in our favored sectors continuing to remain very robust. Keith mentioned earlier that the fund strategy is a continuation of what we have employed in Fund 3. Our focus is on Europe's top 25 cities. That is where the liquidity is. That is where the population growth is. That is where the GDP growth is as well. The fund will focus on the property types that are performing the best, which are predominantly industrial strategies, living strategies, and increasingly the alternative property types such as triple net lease, housing, self-storage, all of which are seeing significant growth trajectories in Europe at this time. So I'm going to pause there, and I know you're short on time, but I will open it up for any questions that you may have.
Yourself? So I'm Avni Dudley. I'm the relationship manager for Ares for New Mexico SIC, and just want to reiterate our gratitude for the strong partnership of our organization. Thank you for the consideration.
I'm trying to have one question. Based on, because this is a relationship we've already had in the past, if you could remind me whatever we thought that the earnings were going to be, did we match to that? Were we higher than that, lower than that? I think that's one of the questions we've been wanting to ask on re-ups is performance of what we thought we would get to and where we're at with that first.
Sure. So we're invested in the prior fund of this vintage is Fund 3, so it's also still just finishing up its investment period. So that comes with a little bit of a caveat. But the fair market, so the target return for that fund in 2019, so pre-COVID, but 2019, was an 8 to 11.5% net IRR. Today, it's marked at a 7.5% net IRR. That's on a liquidation basis, with a projected life of fund IRR from Ares at 9. So in that bucket, in that range, and we think that's a good outcome given the vintage and given the strategy, and think about that investment period from 2019 until basically today. It's still early in that fund's life cycle, but in the targeted range that we expect.
So then, to that point, the new target is higher than that. Can you explain a little bit as to why you think it would be higher than what you were able to match up on the previous?
Sure. I'm going to defer to Wilson because he states the target returns and Ares does. We then we'll rely on him to.
So you made your last investment in EPEP 3, and what Seth has just described is 100% correct. When you look over the entire life of the EPEP fund series, back to a 12% net. So at the top end of the old target and at the top end of the new target. We decided that for EPEP 3, it was quite a wide target that we previously stated. And given what has happened in the markets, given what has happened to the risk-free rate and bond yields, we felt that moving into a higher returning environment, that taking off the bottom 200 basis points was an appropriate adjustment for us to make. We are still underwriting transactions within the 10 to 12%, and our underlying track record backs that up as well.
So we just have questions on the terms, and whether or not we don't really know what to say, or
What we're doing is, we're trying to figure out how to say what we're trying to say, for you to understand.
but
Yeah.
still keep proprietary terms.
So we're not being secretive, but we are.
So are these terms sort of
Similar to our previous fund or to what we've done in the past, and if you could just remind me what, ketchup means, not mustard.
Sure. So I'll just address, the terms are consistent. And our commitment has increased, which gets us a lower overall fee. So there are.
just the raw dollar amount, but we're talking about the percentages.
The management fee.
Yeah.
Yeah, I believe the incentive fee is.
So the management fee remains consistent with what was before. With respect to the performance and the performance profit share and the promote, you'll see here that there has been a small adjustment here where we've increased the preferred return versus what it was before by 100 basis points, and there has been a small increase of the actual sharing percentage from 10 to 50.
And then on the catch-up question, so the way this fee structure works is you, as an LP, receive 100% of your capital back that you invested, plus all the fees that you paid, plus then your preferred return. That's the first threshold. Then from a preferred return of what's stated in the document, up until they get that, the 85, it as well without.
Now you know.
The catch-up is an interim split of returns between you, the LP, and the GP until they achieve a 20% return or 15% return.
So we achieve 15%.
15% of profits, and then it flips to the.
Okay. Thank you, Madam Chair. Thank you for the education. Sure.
Do we have further questions on that?
Based on the recommendation of the Council Investment Committee, Consultant Townsend, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of 200 million euros to Aris European Property Enhancement Partners, SBFP4, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay, we've got a proper motion by the treasurer, second by member Reyes. Any questions or discussion from council on the motion before us? Hearing none, we have to do a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Props.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
9 in the affirmative, motion passes.
All right, wonderful, and thank you so much for being here today.
Thank you for your support.
All right, so we're gonna have Townsend switch out.
Actually, we're gonna stay for, I think, we're still on the next one.
Still on the next one?
QC.
Are we on the QT infrastructure? Yes. Okay, then maybe they wrote down the wrong, consult.
Indeed.
So agenda item 3H, QT infrastructure.
Madam Chair, the story behind both of these investments is identical, so I'll make just the one set of comments to preface this. Pacing, as you're aware, has gone up pretty markedly. We had a couple of funds that we approved over the course of the last 12 months that are still open with extremely high-quality managers, and so we think we should take this opportunity to increase the size of those allocations. We'll keep the presentations brief just because you've seen them within the last 6 to 12 months, depending on the particular investment. Shifting gears to EQT, in January of '23, council approved allocation or commitment of $220 million. That was split $160 million in the main fund and $60 in a co-invest. We're recommending a top-up in the amount of $165 million, split the same way, so $120 million in the main fund and $45 in the co-op or co-investment vehicle. The fund strategy, a broadly diversified global large cap infrastructure player with a European emphasis in terms of the mix. I've had separate follow-up briefings with both the European business head and the head of the U.S. business. They've made a couple of portfolio investments over the course of the prior 12 months. All of those are within a 12-month window from the date they made those investments, and therefore those are all being carried at cost at the time we're speaking. There were no adverse developments in the portfolio strategy over that time. With that, I guess I'll just hand off this stuff for any comments.
Yeah, no real comments. I think that the only thing we'd mention is that, as discussed within this group a number of times, is our plan has grown. If we had the foresight in January of '23 last year of what our growth would have been, we would have committed more at that time, and that's why we're back here today with that top up.
And do we have anyone from the management?
No.
No.
All right. All right, questions from council?
Madam Chair, can you just comment on how the original investment's performing again?
So they've only been investing for about a year, and so the longest investment at this point would be just shy of a year, and those are all marked at cost. The business updates on them suggest that value accretion is proceeding according to business plan. We would expect to see marks in coming quarters on that, but everything is going as it was expected at the outset.
Thank you.
Good question. Do we have a motion?
I do have one question, and
Yes.
I think it's just, the paperwork. I'm on page 525, and this says, which is where we're at right now, right? And it says 45 million and 120. But then I have another paper that says 160 million EQT and 60 million to co-invest on page 529.
Got 100.
So we're already
20 and the 60 was the original commitment.
Right, so we put the original documentation behind it.
Oh, okay. Okay, thank you. I appreciate that, 'cause
120 and 45 in the previous.
yeah, and then the previous is right behind it on January 11th.
We have a motion.
Yes. Madam Chair, based on the recommendations of the Council Investment Committee, Consultant Townsend, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a top-up commitment of up to $120 million to EQT Infrastructure 6 and up to $45 million in the previously established co-investment vehicle, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Oh, we've got a motion by member Case, a second by member Allen. Discussion, hearing none. Roll call.
Commissioner Stephanie Garcia Richards.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Props. Yes. Nick Taz.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
None in the affirmative, motion passes.
Now we're gonna do.
thank you.
So we've got, Mercer joining director table for Ellis Power Pipe, agenda item 3I.
Madam Chair, again, this is a top-up of a prior position. We made the initial investment of $150 million in June of last year. To remind you, this is a top quartile manager in the power space. Their business lines split about 40% distributed energy, 40% renewables, 20% conventional, with a focus on peakers, so being able to fill in the power gaps in other generation technologies. Amy and I did a joint meeting with the management team. They are very early in their investment process at this point, and we found no adverse developments during the course of that conversation.
Yeah, just restating, you made $150 million commitment to them already. We are asking or recommending to make an additional $100 million. Again, it's a top-up opportunity. The managers in this space are not large, and so we think with a top quartile manager, it makes sense to make a top-up. And then they are on track to hit their $3 billion target. Final close coming up very quickly. So again, this is one where we're opportunistically been watching them, and we have the ability to put in some more capital. They have made 2 investments so far, a green hydrogen project investment where they'll be working with some renewable energy projects, and then a large-scale combined cycle gas turbine. So the 2 investments look right in the direction of their strategy, and their track record of previous funds continues to be very strong. So,
Madam Chair, can you guys please explain a top-up versus a re-up for our new members?
Sure. A top-up is a follow-on commitment to a fund that we've just made a commitment to that has not yet closed. And re-up is investing new dollars into the next fund in a sequence of funds.
Of the same manager.
Of the same manager. Same series within the same manager.
And Madam Chair, my question would be, did they already utilize the funding that we had given them from last year in June?
no, so they're still fundraising. They have used some of it because they've done 2 investments so far, but they still have a large amount of unfunded, big pipeline. They have a very large pipeline that they're looking at to date. So they put some of it to use with those 2 investments, but their investment period is 4 to 5 years. So we would expect them to drive on that capital for the next 4 to 5 years.
And then so the recommendation to increase that amount into that fund, and they're still working on it, can you explain to me a little bit more as to why we would do that?
So one is the pacing issue. We've identified an extremely high-quality manager with additional capacity, and we've already done the legwork from a diligence perspective. And then the fund is still open, and so we are restricted to putting money in when they're actually open to taking it. So we wait until after the close, and that opportunity just passes us by.
Yeah, same with the EQT one you just heard, where if we would have known the pacing when we made the original, we probably would have gone larger. But now that we have the larger pacing and they're still open, we would like to deploy some more capital with a good manager.
Perfect, thank you.
Madam Chair, based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary Oversight of RVK, I move that the State Investment Council approve a top-up commitment of up to $100 million to LS Power Equity Partners 5, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second motion.
Okay, we've got a motion by Member Allen, a second by, none, we're going to do a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
UFA Secretary Wayne Props.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
None in the affirmative, motion passes.
Great, thank you so much. All right, next we're going to call up Director Lofton and Nikita for agenda items C, J, and K.
All right, so, I know thank you, Madam Chair. So, up here with me, Mary Bates from Nikita on my right, her left, and Reggie Ross, also from Nikita. We'll keep Reggie up here for the
the next presentation, for Portslight. So this is a top-up, recommendation, exactly as, Director Sable described. In fact, we'll use both terms. Our investment to, SCF3 was a re-up from SCF2, and then we're topping up SCF3, and it's the same reasoning as before. Our pacing has more than doubled, so therefore, when we think about our diversification across strategies and across managers, and what the appropriate commitment amount is, depending on the manager, complexity, and the strategy, had we known now, or had we known then what we know now, the original commitment would have been $300 million. So we're asking for an additional $100 million commitment. With that, I can turn it over to Mary if she has anything. And also, as mentioned, Ed Millay, co-founder of the firm for Silver Point, is on the line if there are any questions.
Perfect. So very, very briefly, as a quick reminder, Axia underwrote this strategy. We supplied our writing or our underwriting for this strategy. But as a quick refresher, Silver Point Specialty Credit Fund 3 is a non-traditional direct lending fund. So why we're comfortable increasing the commitment to this strategy is that it's highly diversified at the loan level and at the industry level. Performance is meeting expectations. So the return target for this fund is 10 to 14%, or 11 to 14% net IRR, and performance is in line with that. Very strong downside protection. You have 0 basis points of loss in Fund 3 and 3 basis points in the fund. So very, very low downside protection. It's a diversified strategy also across strategies. So what I mean by that is they also have some flexibility to do some non-traditional lending strategies, which we favor. A couple of things that we would bring to the attention of the council, just in the spirit of thoroughness, is there has been some turnover at the senior level. So the two senior PMs, portfolio managers for real estate, which is a very small percentage of this fund, but they did touch this fund, did leave the firm, and the firm did retain additional talent. We're comfortable with that, but we want to make sure that you're aware of that. And then you will recall we were here in the fall when we underwrote the manager's distressed fund and did bring to your attention, I believe, Treasurer Montoya, questioned the manager in terms of their diversity statistics are below average. But happy to address any questions. And Ed Millay, one of the co-founders of Silver Point, is on the line if you'd like to hear from him as well.
Millay, if you could maybe talk about the impact of the departure of the two portfolio managers that Mary talked about, sense of the impact.
I'm sorry, was that addressed to me, Ed Millay?
Yes.
Oh, sure. So the two a relatively narrow slice of what we do in this fund is direct lending to basically small real estate projects. One of our senior people really decided to leave and go off and invest on his own for his own account. We had hired another person prior to that that we were really had focused on the second person as being a person to help us grow the business. I think that caused the first person to decide that maybe we didn't have confidence in him to grow the business, so he left. And the second person that we hired turned out wasn't as good a fit for our organization as we had hoped. And so we have recently hired another senior person in to continue on investing in that relatively niche portion of our lending strategy. It's generally a small portion of our funds, typically around 10%.
Quickly,
when we do a top-up, is the fee structure the same as what we had originally done, or does it end up going lower because of?
Our fee structure is
Perfect,
improving.
thank you.
Yeah, you actually, we obviously can't disclose the amount, but it's a meaningful, fee savings that you'll.
Meaningful fee savings is what we like to hear.
She already did all the due diligence of it too, and the piecing is great. So, based on the recommendation of the council investment committee, consult with Akita, FXC staff, and general fiduciary oversight of RBK, I move that the state investment council approve a commitment of up to $150 million to Silver Point Specialty Credit Fund 3 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Got a motion by the treasurer, a second by member Kaya. Discussion on the motion. Roll call vote on the motion.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
EFA Secretary Wayne Props.
Yes.
Nick Taz.
Yes.
Catherine Allen.
Yes.
Don Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
9 in the affirmative, motion passed.
All right. All right, agenda item 3K, Torchlight Debt Fund 8.
Thank you, Madam Chair. So this is a new relationship for SIC. It's a recommendation for $150 million to Torchlight Debt Fund 8. To help me with this presentation, I have Reggie Ross from Makita, who specializes in real estate underwriting within Makita. And to my right, I have Mary Schmidt-Zulik, Greg Deneen, and Sam Chang. I'd like to point out that Greg and Sam are on Torchlight's investment committee, so anything that goes on, anything that's going to be approved, they're the ones that are going to have to say that it's okay. So good people to ask questions for. Just real quickly, this fund will target public and private commercial real estate investments across performing and distressed. Okay? So with that, I'm going to turn it over to Rich.
Thanks, Director Lofton. Madam Chair, members of the committee, Reggie Ross, happy to be here. My first time in Santa Fe. Looking forward to making many more trips back. So just very quickly on a couple of things that we like about Torchlight and Debt Fund 8. First is the experience of the firm. They started in 1995, so have almost 30 years of experience investing in real estate debt across multiple market cycles, which we think will come in handy if, as some people say, we're going into a volatile period in the real estate markets. We think that experience comes in quite handy. Second, they're going to be building a highly diversified portfolio of somewhere between 75 and 125 individual investments. And so from a risk mitigation standpoint, you don't want to have your eggs all in one basket. And so the portfolio is expected to be highly diversified. And then third, the last point I'll make is that they have a flexible mandate, as Director Lofton stated. And again, if we believe that we're going into a period of uncertainty in the real estate markets, we do think that flexibility to target investment opportunities where they see the best risk and return opportunities presents well for the investment. So with that, I'll turn it over to the Torchlight team.
Great. Thank you, Reggie, and good afternoon. Thank you for having us. Again, I'm Mary Schmidt-Zulik, an SVP in Business Development, and I'd like to point out that Greg Deneen, who is our Co-Chief Investment Officer. Greg has been at Torchlight for 8 years, and Sam Chang, our Head of Portfolio Management, who has been at Torchlight for 26 years. We also have our partner and Head of Client Service on Zoom, Heidi Kaufman, who has been at Torchlight for 8 years. We have a very senior and stable investment team that have invested together across multiple market cycles. As Reggie alluded to, we have been doing this for almost 30 years. Real estate debt is our bread and butter. We have $6.3 billion in AUM today. We have about 60 employees. We're located in Midtown Manhattan, and we're fortunate to have some of the largest U.S. pension plans for current investors.
Thank you, Mary, and thank you, members of the council. Just briefly on our strategy,
As Reggie pointed out, we are a flexible mandate, which we think is one of our differentiators. We invest in both public and the private credit markets, up and down the capital structure, where we think we can identify and allocate to the best relative values. So from a diversification standpoint, we're investing on the private side in senior mortgages, mezzanine loans, and preferred equity. On the public side, we're investing across CMBS and also the Freddie Mac case series. We look to create downside mitigation by anchoring our portfolios with a mixture of senior mortgages and investment-grade bonds, and we look for higher returns and yields through participation in assets that we think have upside. Historically, in terms of our portfolio construction, we have been very shy with the use of leverage, and we think that's another differentiator in the marketplace. We've averaged less than 15% total leverage, fund-level leverage across our portfolios. More recently, we have avoided some of the sectors that you'll read about in the real estate markets that have underperformed, including first loss CMBS positions and office, which comprise less than 5% of our total portfolio. Where we have been more active is on the multifamily sector and industrial properties, which comprise nearly 70% of our total portfolio. We think we're well positioned in the current market environment to be more offensive.
Thanks, Greg. Good afternoon, ladies and gentlemen, and thank you for the time and the opportunity to present to you all. To continue with some of our differentiators, as Greg mentioned, we invest in both the public and private commercial real estate debt markets and have been doing so for close to 29 years, invested over $30 billion in all those products. Having access to both the public and the private markets allows us to pick the best risk-adjusted investment at any given point during the market cycle. This allows us to diversify not just within the product, but with property types as well as geography, thereby de-risking the overall. In addition, when analyzing real estate debt investments, we obviously start with the fundamentals of the real estate. We also focus on things like current cash flow, thereby we are generating positive returns from day one, or at least putting ourselves in the best position to generate positive returns from day one. In addition, we structure our investments such that in a lot of cases there's upside in the debt, embedded in the debt, thereby getting both the benefit of the debt with the protection of equity and the upside of the equity as well. In addition, and thirdly, our final differentiator is we have a distressed debt workout team. This team has 26 years of experience working out distressed loans across the United States. This allows us to navigate the very complicated legal matters when working out a defaulted loan, thereby maximizing the return for our investors. And then throughout our debt fund series, the first one started in 2003, debt fund 1. We've been consistently targeting and achieving about a 10+% net IRR, along with achieving an equity multiple of about 1.4 to 1.5 times, thereby reflecting the low amounts of leverage that Greg mentioned, as well as the careful deployment of your capital throughout the investment period. And with that, hope you find this presentation helpful, and we will happily open it up to Q&A.
All right, questions from council? What page is the target net IRR on?
So the target, the page for where I listed is on page 651. I'm not sure on the Makita presentation.
I got it. Thank you. Yeah. Madam Chair, nice to meet you all, and thank you for being here. Because it's a new relationship, why haven't we gotten in this relationship before, is my first question. Second question is, how did your previous fund do? And based on how it did, what are some of the lessons that I learned for this new fund?
I'll let Mary answer the first question. Why have you not started this relationship? But in terms of our fund, our prior funds, generally speaking, have met their target returns. I think the latest one, the one prior to the latest one, Fund 7, is a little bit behind our current return target. With that being said, we do the net return to date is about 4.4%, and the target is about 10 to 12%. We do think that on a go-forward basis, our current income is going to increase due to the rising interest rates. So on a go-forward basis, there's also some embedded gains that we will look to realize at the end of the fund's investment period, which is coming in September. So about 350 basis points, of additional return is going to come from that between now and the end of the fund's life. Another 250 basis points in current income.
For Fund 7.
For Fund 7, correct, yeah.
I mean, we've got the performance here.
And I would point out in their defense, and not to throw Director Sable, your asset class under the bus, but if you look at all commercial real estate as a whole, even on the equity side, with the change in interest rates, a lot of the underlying dynamics going on, it's been a difficult time for, the past few years, been a difficult time for real estate in general. So that's also been contributory.
And Madam Chair, to that point, that's why I asked, because I know everybody didn't do well. And it's how bad did you do, or, how up to the level of bad did we do on that end, and what were the lessons learned in that type of market environment? I mean, it's obvious that you guys have had, this is your bread and butter, this is what you really have been doing, and you're focused on it, so you've gone through different market environments throughout. This was just one of those hills. So I'm always just curious with someone that is detailed in that skill set, what are some of the lessons learned that you could bring to the new funds that you're asking us to invest in? Because it does help all of us as well as we're looking at other deals. The other question I was going to ask, there's Supras in here. Can you talk to me a little bit about your limited partners and what relationship, or how do you connect your Supras into your portfolio? Or do you? Is this the same for nationals?
What page do you see that on?
687. Yeah. I was just curious because we invest in Supras, and it depends on what level you go into nationally or internationally, and it was just more out of my curiosity. It's not a big question.
That in the report, right?
Yeah.
I can ask off-site.
If I can address it while we do this,
Yes.
your first question. We have been speaking with NMSIC for many years, and actually it was more with some of the former investment colleagues, former investment team at NMSIC as well as Townsend. And now with the change with Makita becoming the consultant, I believe it was in last year, private credit, which included real estate debt, is how it is. But we have actually been speaking with, again, former investment members of NMSIC are going to strategy.
She's asking about supernatural.
Right. So, Madam Treasurer, this is actually in the Makita report, and I don't know how much Torchlight can disclose in a public meeting, but in our list of limited partners that have committed to this current fund, we asked for, an entire list, and the way that they characterize this particular investor, rather than putting their specific name, they have to characterize it as a supernatural or supranational organization.
Yeah, so I understand now, yeah. So a lot of our investors prohibit us from sharing their name. As I don't know if that would be a requirement in New Mexico, obviously if it was, that too, but we can provide more color on our LP list if needed in terms of profile, criteria, that sort of thing.
I just appreciate the diversification of having Supras. I was just curious if it was more national or international, like in New Mexico, state statute, I'm only allowed to invest in Supras nationally. I can't go international. So I was just curious because there's a good diversifier, and it actually helps a lot of communities in the type of work that you're doing when you're investing in that. So it was just, yeah, sorry. Further?
Go ahead. We're on Torchlight. Based on the recommendations of the Council Investment Committee, Consultant Makita, SIC staff, and general fiduciary oversight of RVK, move that the State Investment Council approve a commitment of up to $150 million to Torchlight Debt Fund 8, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second the motion.
Okay, we've got a motion by Member Messina, second by the Madam Treasurer. Any discussion on the motion? None, we'll take a roll call vote on that motion.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Props. Yes.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
9 in the affirmative, motion passes.
Thank you. All right, that is 10 investment votes. So we took longer than 35 minutes, but we didn't take too long. We'll move on now to agenda item 3L, where we'll hear about, contract recommendations from, Gail Nestor.
Gail's gonna be on the,
On Zoom, great.
Thank you, Madam Chair. State Investment Office would like to recommend a contract extension for 3 years with BlackRock Aladdin eFront multi-asset risk system for an additional 3 years at a cost of $694,000 a year. So all the user cases are listed on pages 746 and 747 of your materials. In a nutshell, let me just remind you that BlackRock is a multi-asset class risk system consisting of 2 parts. Aladdin, which covers all the public asset classes, as well as eFront Insight, which covers all the private asset class analytics. You have seen the glimpse of the system's capability over the last year when we presented a couple of whole portfolio view risk analytic reports. This year, we will do it more consistently, and also we will expand that report to include the high-level overview of each individual asset class. So you will see quarterly reports including the total portfolio, as well as 6 individual asset classes. That is one side of the equation. So that's just the classic oversight function capability of the platform that includes, but is not limited to, exposure analysis, concentration analysis, setting up risk targets, and things like that. Also, during this year, we are planning to expand the system capability, and we will also start presenting and try to use it as an advisory tool, as an advisory part of the investment due diligence process. So what that entails is, if we have a new investment, whether it's a public market allocation or a new investment within the private asset class fund, we will be able to take a sample portfolio, run it through our risk analytical system, and come up with the risk return profile of this particular investment. And we will be able to see how does this allocation change the risk metrics and risk analytical numbers of a particular sub-asset class, as well as the asset class and the total portfolio as well. So that's also in the plans for this year. During the investment council meeting, there was a question about some of the other providers in that space. So 3 years ago, when we went out and we evaluated the space, there were 3 finalists. One of those finalists they're all 3 functioning as of right now, but one of those is using Proxin for private asset class analytics, which just doesn't provide accurate and reliable numbers on the private asset class side of things. So we decided not to look into them any further. And the other company, it's called MSCI Barra. They have recently acquired the private asset class analytical platform called Burgess. They are decent. The problem with them is that they are just in the beginning of the implementation process. So while eFront Insight has already been implemented into the work of BlackRock Aladdin, and it's just a one tool for both private and publics, MSCI is still at the beginning of implementing and integrating all the capabilities and flexibilities of the Burgess system. And in our experience, it's going to take another 1.5 to 2 years minimum. Plus, the price that they quoted was about $150,000 a year more. So after internal discussions, we've decided to just continue working with BlackRock Aladdin. And that's why we would like to recommend a 3-year extension with them. And with that, I will take any questions if there are any.
And Mr. Kuznetsov, did you talk about whether or not this, I catch everything, this is, price is paying?
I think so.
Yes.
Yeah. McCall knows.
I believe it is.
Yes, it says no, the FIO was able to negotiate no fee increase and was given the same price as 3 years ago. Shouldn't we be getting a better deal already?
Inflation.
We didn't, any questions for, on this, contract renewal?
Does staff have anything to say about it?
Madam Chair and Treasurer, I will tell you that initially, the feedback that I got on the renewal is they were going to base it upon the volume or the level of our assets would have caused a big increase. And I kind of balked at that, and I said, you need to go back and push them a little bit and see what you can do. So this might not seem like a reasonable price, but from my point of view, it's a very reasonable price if we're going to continue with it. So.
And so who, our directors use it, or who?
The whole team does, Madam Chair, in various different ways. So strategy reviews it mainly for the whole portfolio view, our risks are in place, the asset class directors look. So we went without a risk management system for years and years. There just wasn't one on the market that, you know, I felt like we've got such a large portion of our portfolio in private markets, and that's the hard part of risk management. There just wasn't one on the market that I thought did a good enough job. Private assets.
And so then my question would be, in 10 years there's enough?
I think so. Yeah, we're 13, but you know, have specific things, not as specific.
You don't get emails like we do at the land office. Can someone get blood off RTAS?
That happens occasionally.
All right. Everybody, based on the recommendations of the Council Investment Committee and SIC staff, I move that the State Investment Council approve to extend the BlackRock Aladdin eFront multi-asset class risk system contract for 3 years under terms and conditions set forth in the meeting materials and discussed by the Council today.
Second.
Okay, we've got a motion by Member Allen, second by Member, Kiss. Discussion on the motion. Hearing none, we'll take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Props.
Yes.
Nick Tejas.
Nick?
Oh, yes.
Catherine Allen. John Bingaman. Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
8 in the affirmative, motion passes.
And then finally, our last voting item is the appointment of a investment committee chair to replace the departure of Member Lavender. So we'll turn that over to Member Taylor to make the presentation.
Correct, Madam Chair, members of the council. So with the departure of Member Lavender, we have a very large void to fill in the Council Investment Committee. And we have all of these investments that we discussed today, and most every investment that comes to the committee has to go through that CIC vetting process, and it's a really big and important role, and so we don't want to miss a step with having to go multiple meetings without the chair. I think we have our policy related to CIC requires that we have a chair, and that the SIC appoints that individual. And so with that, the current members are myself, Member Messina, John Ulrich, and as an advisory member. They technically do both, but, yeah,
But they don't have council.
they don't have a council, yeah. So, John Ulrich is an advisory member and Mary Roman as an advisory member. So we're a committee of 4, and, we do need that 5th or maybe a couple more members. And so, with that, I would like to move that, we appoint, member John Bingaman as the Council Investment Committee Chair and, assume that role.
Second.
Yeah, so I'm wondering if Member Bingaman knows that he's being nominated?
If he's not on, it's tough.
I did rejoin the call. Sorry about that.
So Member Bingaman, you're being nominated to chair the investment committee. Are you, okay with that?
Absolutely. Be an honor to serve.
Great, I think it'd be a great fit. So we've got a nomination by, Member Tiff, we've got a second by
Member Allen.
Member Allen, the DSA secretary, a unanimous. Any discussion on that nomination? We will take a roll call vote on that as well.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Props.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Mike Messina.
Yes.
9 in the affirmative, motion passes.
All right, congratulations, Mr. Chair.
Yeah, and thank you, John, for taking it on. That committee does a big chunk of the work. Is there a vice chair in policy, or do we do a vice chair, or should we do a vice chair?
There's none in the charter.
Okay. Something we should consider, just because people do have busy schedules, and those meetings usually last 3 to 5 hours. I do appreciate going to those meetings, and I would recommend to the new members, that's what helps me not ask as many questions as I do in the SIC meetings, and it really helps give me some guidance, and then I have a week to talk to the staff about anything that I'm still needing some help on. So I would ask to Member Tejas' point, for more people to participate in being members of that committee, however that works.
On that point, Madam Chair, if I may, I think that the charter states that we can have 5 members from SIC on the committee to avoid the quorum situation. So there's that. And I think it's a great idea to have a vice chair or something similar to that, because I just showed up at the meeting and we didn't have a vice chair, and the charter of the CIC says that, you know, the chair is the one that leads that committee, so I felt really uncomfortable.
Two things. Can the committee appoint the vice chair? I think. Secondly, I just want to mention, we have to do some communication if you're intending to come, because we can't have 9 members of this council, or we have a quorum and it's an open meeting issue.
Got room, actually, for.
Oh, yeah, we've got.
Potentially. So if you want to attend, just let staff know. All right, so now we'll move on to agenda item 4 and hear from our CFO.
And Madam Chair, I'll be super brief. I'm going to touch upon one slide, page 749. For our new members, as I do every month, I've included a budget to actual schedule. I will say I'm not anticipating any problems through the end of the fiscal year. If you get back to your homes or offices or wherever you're at and have questions, anything you want to ask me, I'm more than happy to answer any questions. And then lastly, I have also included the investment holdings report for January. That investment holdings report is a very important report. You can go and see what the assets are for a particular fund. You can see a roll forward of activity from a prior month.
If it's a quarter end, you will not only see a roll forward from the prior month, but from the prior quarter. So anything that you want to know as it relates to our investments and the related funds is within that investment holdings report. And then finally, our external auditors, Moss Adams is completing their agreed upon procedures for the first 2 quarters. That's the quarter end in September and the quarter end of December. Those reports are due by the end of March. We will get those to you distributed as soon as we get them in. I did want to emphasize one of the things that we really believe in as an organization is we really focus on monthly activity and doing on a monthly basis what we need to do to prepare for the audit. We're constantly preparing for the audit. That's probably the biggest responsibility that I have, is making sure that we can navigate our external audit. And the reason we're so successful is the fact that we just stay up on things and report things on a monthly and quarterly basis. And that's all I had, unless there's questions.
Just 2 questions. Do we have an internal auditor, or do you serve as that, or do we have that?
Member Allen, in the past, I think the first couple of years I was here, we had Red W, who did some internal audit services. Generally, we found that for the services that we got, it wasn't worth the value. Just remember, on the external audit, the external audit side, they have to come in and actually do quarterly agreed upon procedures, which includes purchases and sales, contributions and distributions. They do a sample. Some people say, well, why aren't they doing this every quarter? Purchasing and selling, distributions and contributions is what we do. It's the bulk of it. So the agreed upon procedures probably is the key from our point of view, and we're having those done, and we'll continue in the future, and that's part of the requirements by statute. We have to have those done.
And I just think we have to take this back to the strategic plan. As we move from 52 billion to 100 billion, there's going to be other things we're going to need to think about. One might be some kind of internal auditor, something like. I think we're doing a great job.
Yeah, I'm definitely open to it. I don't have any problems. It's just, whatever is being done, you want to feel like you're getting some sort of value, and sometimes you do and sometimes you don't.
Yeah. And then the second question, again, talking about strategic plan, are there funds, is there a budget somewhere for having outside expertise to help do research in putting together a strategic plan or doing research on the New Mexico investments or things like that? Do we have any kind of consulting fund for that type of activity?
Member Allen, other members of the committee, I'm not saying we necessarily have a fund, but I would think it's all investment related, and I think it would all fall under our budget. So if there's additional dollars that we want to spend in that area, subject to, discussing it with John, I think we probably have room to make that happen.
All right, thank you.
Yeah, Madam Chair, Member Allen, I agreed. I don't think there's any problem with funding, outside consultants who come in and advise the council in your strategic planning. That seems very reasonable.
There's room, Madam Chair, there's room under professional services, under that line item.
Right.
Mention one other thing. Madam Chair, and Brett, great job, as always.
Yeah.
Is it possible maybe to put the percentages on the back side of page 751, maybe even the 752? And the reason for that is it helps to not have to look at the numbers, recalculate to see where you're at within the month of the 12 months, so we can see if we're in alignment with where we should be for each line item, or at least if there's a difference, we can see what that looks like. It helps me on my budget.
Sure.
To know. And then the last thing is, from last meeting, we did look at the investment policy, Member Summer, Member Tellis, and myself, and we have those recommendations to give to you guys to take a look at and give enough time for us to come back. It's only looking at the things that we talked about before. We really do need to revamp our investment policy more than that, but at least to get that part on task. And then John just walked out, but I just want you all to know that John, my general counsel, is leaving me, and I'm so sad about it. but he's really doing something that is a dream of his, and gonna be an administrative, judge for PRC. So Friday is his last day, so I know we're working on the MOU, and we'll get that, I think in Evan's hands right now. But he's really been a great, team member and an asset, and he's brilliant at what he does. And so I think no matter what capacity he's gonna do good for New Mexico. And so I think he's helped a lot of our councils, boards, and commissions as my right hand on those, and so I just want to make sure y'all know.
Member Tiff, do you have an audit report for us?
Audit report. Yes, we met with the audit committee. We met with the audit committee yesterday, right? And we reviewed all of the different investment holdings and the budget to actual, a lot of the things that Brent already talked about. And so we're on track. That's basically about it.
Yeah. And Madam Chair, I just want to thank Nick. He's been a busy man. Getting on both committees.
I'm sure that the staff has talked to the new members about the opportunity to serve on committees, but the audit committee is one, governance committee, you heard about the investment committee, and so, if you have particular interest on the workings of the council.
And governance.
And the governance are good ways to do service. Yeah. All right, so with that, we're gonna go to agenda item 5A and have our new members introduce themselves, which I should have done at the very beginning of the meeting, and I was too discombobulated. So we'll start with Member O'Donnell.
Okay, well, thank you, Madam Chair. My name is Kelly O'Donnell. I have very honored to have been appointed to this position. My background is I have about going on 30 years of experience in New Mexico public finance, ranging from working in the tax department and in economic development and in regulation and licensing, as well as at UNM as a research professor of public administration for 7 years. I have a doctorate in economics with a concentration in public finance from UNM. 3 kids, all born and raised and graduated from UNM and off to their various careers, and mostly in other states, unfortunately. Right now, I currently serve as the Chief Research and Policy Officer for HomeWise, a nonprofit here in Santa Fe, and I'm also an economics consultant for a wide variety of New Mexico entities. And again, it's an honor and a privilege to be here. Thank you.
And a great economic analyzer.
Yes.
Great analysis. I get Kelly to come with me to the land office when I first got elected, and she refused.
Yeah, thank you for the great welcome from everybody. Alan Sanchez, I'm the president of CHI, St. Joseph's Children. We have a trust of $110 million that was created from the sale of the St. Joseph Hospital, but still part of the national organization that owns us, which is Common Spirit, the largest healthcare provider in the United States, nonprofit healthcare provider in the United States, with 145 hospitals in 23 states. In New Mexico, all of our funds are dedicated to the children of New Mexico. St. George doesn't take a penny of government money, so it's all off of our own trust. Been an advocate for the children of New Mexico, worked for the bishops also, been on committees for the U.S. Conference of Catholic Bishops, the Institutional Advancement Board of the North American College in Rome, was educated in 2 pontifical universities in Rome. And people were teasing me when I said I'm going to this, and they said, "Oh, you're not used to working with new money, you're used to working with old money." Yeah, old money that has, a few emperor's faces stamped on it there, coming to this great institution that New Mexico has. I'm just so proud that what the work you're doing, what you've done, and I thank you for all your hours. I'm seeing now how much hours you've committed to this thing. But the prosperity of the children of New Mexico are relying on you. You've done an amazing job. And so to be here, I'm humbled and look forward to contributing whatever I can in supporting this great institution.
Well, I think I speak for the rest of us when I want to just extend our welcome to our brand new trustees. Any more older new business?
Well, I think
Yes,
we
Member
should
Messina.
do a welcome to our new state investment officer. We're so happy to have you, John.
Yes.
Thank you.
Okay, hearing no more, our next meeting is Tuesday, March 26th. That is here in the Capitol in the, Cabinet Room. And then I'm going to ask if anyone has signed up to do public comment.
Madam Chair, not today.